K. I welcome all of you for this evening's VCM. I hope and wish everyone is good and safe in this pandemic time. As the chairman, CA ACS Reddy Garu, welcome ACS. Dear members, today we have with us CA Mitesh Sai and CA Rajesh Vaishnav to talk on practical challenges and recent changes in transfer pricing and tax audit, which is most relevant for all of us to close our audits and to go further. Welcome both the speakers and all the members once again. Friends, we all know transfer pricing is an accounting and taxation practice. It's applicable to within or among the business verticals, subsidiaries, which are under common management control. Again, there are various methods of pricing the same. Members, we thought of hearing the same from CA Mitesh Sai, who is an expert, one of the experts in this field. Again, with the queries, issues, and updates which we need to update for us so that we can justify our audits and working. Today we have with us CA Rajesh Vaishnav. Welcome, Rajesh sir, who is going to address on this specific topic, tax audit with respect to changes and any clarifications or question answers. Before handing over to the speakers, it's our privilege to introduce today's speaker, Chairman CA ACS Reddy Garu. To introduce to both the speakers, please.
Thank you, Secretary, for giving the opportunity to me to introduce today's speaker. It's my privilege to introduce Mithilesh. CA Mithilesh is a practicing chartered accountant, qualified advocate, certified professional in international taxation and forensic audit, and possesses over 13 years of experience in assisting clients on taxation, transfer pricing, and regulatory matters. His core areas of experience: transfer pricing, advisory, TP documentation, representation before revenue authorities, and IT/AT. Experienced in filing advanced pricing agreement, that is APA bilateral and litigation and related assignments, global transfer pricing review for multinationals, planning before BEPS, CBCR requirements, and preparing master file, local file documentations, preparing dispute resolution panel applications and drafting appeal documents and representation before DRP panel and commissioner appeals, representation before income tax appellate tribunal and handling litigation practices, international tax services, inbound and outbound advisory, providing advisory services in the areas of Indian taxation, international tax, and double taxation avoidance agreement, US, UK, and Singapore taxation, direct tax advisory, compliance and handling litigation cases with vast experience of dealing with complex affairs in direct taxes, tax planning, and assurance. Advising clients on managing their tax structure, including outbound investments, evaluation of alternative cross-border operating structure for the businesses. Transaction tax and corporate tax advisory services to the clients in technology, pharma, construction, and real estate industry in the related to tax, FEMA, SEBI, and stamp duty regulation matters. Tax due diligence for various listed and unlisted clients and liaising with statutory authorities, bankers, lawyers, company secretaries for various clients. His core credentials are experience in litigation handling, represented more than 15 tribunal appeals before Hyderabad IT/AT, more than 100 CIT appeals, and DRP filing and representations. Core experience in transfer pricing, planning, advisory, documentation, and advisory for multinational in transactions, structuring, evaluation of models, and providing analysis on the most efficient alternative. This is a brief profile about speaker CA Mithilesh. Now I'll introduce CA Rajesh Vaishnav. Sir, CA Rajesh Vaishnav is a chartered accountant, has over 5 years of experience in tax and regulatory areas. He carries focused experience in Indian income tax litigation and compliance, including international tax, withholding tax, FEMA, and FDA regulatory advisory. His other experience areas includes due diligence, statutory, and tax audit. Rajesh has assisted clientele across various sectors, especially in manufacturing, technology, pharma industries. Rajesh was earlier associated with Big Four and has assisted various MNCs on complex litigations and advisory matters. So this is the brief profile about CA Rajesh Vaishnav. Now I am handing over to Secretary.
Thank you, HF Garu, for your detailed introduction. Now I'm requesting the CA Mithilesh to take forward the session. Members, in between, if you have any question answers,
Please post in only Q&A section.
please post the questions in the Q&A session so that the speakers will take up at the end of the session.
Yeah. Thank you so much, sir, for the introductions and for the formalities. Let's get going with the session. So we have 1.5 hours to cover a vast subject. I mean, it's only one section in the Income Tax Act, but obviously there is a lot of litigation, a lot of challenges, and a lot of hype around the transfer pricing scrutinies and assessments for the MNEs, especially multinational enterprises or the foreign companies which have come to India. So why such kind of challenges and why there is so much litigation? What is the subject talking about? What are the formalities or compliances that has to be done in relation to transfer pricing is what we will understand. First, we will go through the basic concepts. So this is the overall subject matter or the topics that we're going to discuss. And I'll just take you through the concept and the basics in the first 15-20 minutes, and then we can jump on to the recent litigations or the challenges that we are talking about in online filings or in the overall scheme of things, the global forefront, how the transfer pricing arena is evolving and how it will impact India. So coming back to the concept of transfer pricing as such. So what is exactly transfer pricing? The comparison of the arm's length price, which is an independent transaction scenario in terms of the taxpayer and an independent entity and the deal or the transaction that happens with both the parties in terms of goods, services, intangibles, loans, and guarantees, vis-a-vis a related party transaction in terms of the same transactions. So if these both are compared with each other, how the transaction price, which is between the associated enterprise and the taxpayer, and an arm's length price has to be compared, and how it has to be benchmarked, how it has to be documented, how it has to be justified, is the entire subject of transfer pricing. So why there is a requirement to do this kind of benchmarking, or why there is a requirement of justifying, and why such a subject is actually required. In terms of the related party transactions, most of the entities or global companies, you would have heard, globally, even big companies like Apple, Google, Microsoft, Amazon, all these guys have been questioned on their shifting of profit and storing profits in low tax jurisdictions. So establishing entities all over the world, wherever there are low tax jurisdictions, and dealing with them from their forefront, that might be US, India, Singapore, or any other holding jurisdiction, and parking of the profits in such jurisdictions through the related party transactions is one of the famous tax saving avenues or tax saving options that MNEs have sorted to. So in such a scenario, wherever there is a related party transaction, the OECD global framework, along with all the countries, have adopted this transfer pricing concept, and they have been comparing the arm's length or independent transaction scenario versus the related party transaction scenario. So this is a brief about why or how the transfer pricing has evolved and why this concept is so famous. So in terms of arriving at the arm's length price, what we just discussed with in an independent scenario, why or how it has to be adopted. This particular arm's length price has to be adopted through a prescribed method. In Indian Income Tax Act, there are 6 methods that have been prescribed or adopted, and these 6 methods are specifically discussed in 92B, 92C, where the computation mechanisms or the methods have been discussed. We'll go to that topic. But in terms of arriving at this arm's length price and determining whether they fall within the arm's length range or not, again is a different subject matter, because plus or minus 3% is famously accepted. Earlier it was plus or minus 5%, but now they have reduced it to plus or minus 3%. This arm's length range earlier used to be plus or minus 5% before 2015, 2016. they have brought this plus or minus 3% amendment. And also in terms of the 2014 or 2016 amendments, this concept of arithmetic mean has been changed to a range concept. So this particular arm's length price computation methods as well as the arm's length range concept has to be understood before going into any further litigation scenario. So I'll take you through those methods and the arm's length range. First, let us understand the sections also briefly before we jump onto the methods and the arm's length range. Section 92 to 92F are the sections for the Income Tax Act where the transfer pricing entire scenarios or the methods, computation mechanisms, documentation, penalties, and the definitions of the international transactions which are covered. Now, consequences of the provisions in terms of international transaction and domestic, specified domestic transactions, if you ask me, international transactions have been there since 2004, 2005, ever since the transfer pricing has been introduced into the Income Tax Act. But specified domestic transactions, even though domestic transactions with 40A2B has been introduced from 2012 onwards, 40A2B was later on removed in 2016. And then from then onwards, only tax holiday related entities in terms of 10A, 80A, 80IA, and now the 115 BAB, which is the 15% corporate tax rate in Tax Ordinance 2019, also has been subjected to specified domestic transactions, which means that any entity which is having a tax holiday and it is dealing with a regular entity, which is full tax paying entity, then the tax holiday entity is generally subjected to the SDT provisions. So it is up to the tax holiday entity to prove that it is not claiming excessive or unreasonable tax holiday. Now, coming to the consequences of these provisions, what generally happens? Now, if we have an income or an expense in terms of related party transaction, we have to subject it to an arm's length test. What documentation has to be maintained? Related party transactions have to be reported in an accountant's report, and it has to be filed online. It's just called as Form 3CEB. Now, maintenance of prescribed documentation, which is the TP documentation, has to be maintained, and as on the date of filing return of income, which is subjected to a test during the course of assessment. It need not be filed online, but it is called as a local file, famously in the recent OECD amendments or in the 3-tier documentation. But still, this file is not required to be uploaded online. This is to be maintained as on the date of filing return of income. In order to ensure, these are the two compliances, 3CB and TP documentation are the main two compliances that have to be subjected to a transfer pricing, arm's length justification. Applicability, if you ask me, even 1 rupee international transaction with a related party, then also your Form 3CB has to report that from an international transaction or a related party perspective. Now, TP documentation, the minimum threshold limit is 1 crore. If and only if you are crossing the 1 crore threshold limit, then only the related party documentation will come down. We will have to be adopted with. If you are not complying with these two compliances, then penalties will be subjected, which is ranging from 2% of the international transaction value to even 5 lakhs. Now, in terms of the international transaction definitions, in terms of what exactly are we trying to adopt, in terms of the basics of the transactions which we might be impacting the international transaction, we'll go through the definitions. 92A deals with the definitions. These are the different provisions of the international transactions or the branches of international transaction definition. Purchase, sale, transfer or use of property, article or thing. These are the tangible things. Intangibles like patent, copyright, trademark, even the employee transfer, which might be subjected to a human capital thing, also would come under the intangible property. Capital financing, any kind of loan transaction, guarantee, any kind of advances, receivables. Receivables is one of the famous topics of Hyderabad and Bangalore transfer pricing offices. Wherever there are receivables, we have to make sure that the credit period is whether they are maintaining a proper receivables within a proper credit period or not. The loan transactions is the interest. Guarantee, we have to subject it to guarantee fee test, whether they are paying any guarantee fee or not paying any guarantee fee, or if the Indian entity has given the guarantee to its parent entity, whether it is receiving any guarantee fee or not. So capital financing is one of the famous litigative topics, but all the transactions will go through and we will explain what trend the litigation is in and how can we adopt a safe stand if we are advising clients in terms of capital financing of the international transactions of the related party. Provisions of services. So basically, all the services like IT, ITS, market research, scientific, KPO, legal, technical services. These are the services mostly, since India being a back office kind of a home ground for most of the global entities. Now, even data management companies, tons of companies are coming into the Hyderabad region. So even those kind of services would be subjected to an arm's length test if you are dealing with an international related party. Business restructuring, in terms of the amalgam, it's not just about the amalgamations and mergers of the international scenario, but in terms of any change in the business supply chain, any change in the profit and loss impacting scenarios, any change in the business model, any change in the assets categorization, any change in the functional analysis can also lead to a business restructuring, specifically in terms of the globalization, especially because of COVID. There are a lot of transactions which have impacted Indian entities. So it is one of the important and interesting topics which has to be reported as part of the Form 3CB and also has to be documented in the TP documentation. We'll go through this, but these are the different international transactions as per the definition of 92A. Associated enterprise, how will two entities become an associated enterprise? The definition of the related party in Indian Income Tax Act, either through a direct relationship or an indirect relationship. 26% is the threshold limit. If direct and indirect participation in management, control, and capital, if it is happening, then the specificality of the associated enterprise definition is what we can fall with. This is the direct impact, this is an indirect impact, the two diagrams that we are talking about. So management, control, and capital, if any of these impacts are there, more than 26%, especially in deemed associated enterprise, these are the quantification details. When we talk about holding, management, and control, if at all these threshold limits are crossing specifically, then we will certainly call them as related party transactions. 26% or more than 26% of the holding, loans, guarantees, and interest, 51, 10, and 10, wherever an asset, wherever an entity is being dependent upon the other entity with more than 51% of his assets being subjected to a loan, then that particular entity is mutually dependent upon the main holding entity. So these two entities would become associated enterprises as per this definition. Similarly, wherever there is common directorship or common directors or more than 50% or one or more executives are common, or appointment is being also controlled by the managing director sitting at US or is a relative of such director, then also the associated enterprise definition gets kicked in. Appointment of such any of the persons, that is an influence that I was just talking about. 100% dependence on intangibles or manufacturing process. If two entities are dependent upon each other for the business purposes in terms of intangibles, processing, trade secrets, or even in terms of the material that has to be supplied, then there is 100% dependence upon each of the entities across the globe. So more than 90% are being supplied as a raw material from one entity to the other. Even then, in a cross-border situation, these entities would be called as related party transactions. So some of the quantifying aspects of 92A2 are being specified here, so that wherever we are going through the facts in terms of our practical clients, we have to remember these kind of provisions so that we are educating the clients and reporting such transactions as part of the related party transactions. And even in terms of the transfer pricing planning, in terms of inception, incorporation itself, we need to be very, very careful whether we are crossing the related party threshold and how the compliances and the documentation and justifications have to be maintained. Now, the deemed international transaction scenario, there are few scenarios where Indian entities are dealing with domestic parties. However, these transactions would be subjected to transfer pricing. How that does it happen? Whenever there is a party A, which is dealing with the third party here in India, A's parent is directly in touch with the third party and having agreement with the third party. Now A delivers to the third party here in India and also receives payments in relation to the same. However, there was a prior agreement between A's parent and third party, and also the terms of transaction have been determined by A's parent. In these two situations, wherever there is a prior agreement and terms of transactions are determined by the A's parent, then it is called as a deemed international transaction as per 92B2. So this is one of the important aspects which most of the chartered accountants or the companies generally miss out because they only look at the surveys or the goods being procured from the domestic entities, and they feel that it is a third party transaction. But however, there might be a prior agreement or arrangement globally, or there might be a direct interaction of the parent entities with these kind of third parties here. So always the relevant question: how did you identify the customer? How did you identify the vendor? And how are you mutually dependent upon each other? Whether there is any global company influence upon such arrangement. These are the relevant questions that we need to answer before getting on to the determination of the related party transactions. Now, as I told you, specified domestic transactions. Earlier, there were 6 clauses in 92BA, where they have removed the 48(2)B clause from 2012 to 2016 onwards. Earlier in 2012, when they initially introduced this particular SDT provision, they have actually specified 5 crores threshold limit. That is, whenever the transaction values are below 5 crore, above 5 crores, then the SDT provisions would kick in. But they have increased that threshold limit to 20 crore in 2000 with effect from 1st April 2016. So now any kind of related party transaction with a specified tax claiming entities like 10AA, ATIA, ATIB or 115BAB, then these kind of entities are subjected to the transfer pricing, and reporting is required if and only if the transaction value is more than 20 crore. So the applicability of SDT comes into picture if and only if there is one entity which is claiming tax holiday among the 2 entities that are dealing, and the transaction value of such entire series of transactions with the related party or the tax holiday claiming entity has to exceed 20 crore as a threshold limit. So 2 conditions. From a method standpoint, in the initial discussion, as I told you, there are 6 methods in the transfer pricing scenario. So in terms of the 6 methods, the first 3 methods are called as traditional transaction approach. The second 2 methods, which are profit split and TNMM, are the profit methods. The last method is the residuary method, which is an overall summary or a residuary item where we can actually take up our own analysis. So in terms of the cup and resale price method, I would first take you through the summary, then we can take up each method as such. In terms of the methods, the 6 methods which are there, the cup method generally is a method where there is an apple-to-apple comparison. It's a transaction-oriented approach. The most famous method which generally chartered accountants use, and they just file 3 CBs specifying cup method. But the point that we need to analyze before applying cup method is plus or minus, wherever there has to be a apple-to-apple comparison in terms of geography, in terms of size, in terms of usability, durability, and also in terms of the specific application of that particular product. So this particular cup method has to be applied only in a scenario where all the conditions, all the comparability factors are common. There should not be any differences at all. So in such kind of situations, only cup has to be adopted. This is a transaction specific approach or a transaction specific method which can be adopted. So only when there is a mere or 100% functional comparability or transaction level comparability, then only cup has to be adopted. Resale price method. This is a method where it can be adopted for any trading entities where this purchase is from a related party and sell is to a third party, mostly importer and local traders. This is the approach that we have to go for RPM. So applicability for RPM. Now, trading options, buy and sell without any value addition, only at GP level, gross profit level. If you are able to arrive at an analysis with related party and outside related party. What is my GP? And similar importers from an unrelated scenario. If I'm say suppose I'm having a brand of my parent entity, I'm just importing that particular brand and doing a trading here, like Samsung or any other vendors with a global brand. And imagine in a scenario where I am only a Bajaj Electronics, where I'm just importing third-party brands and I'm doing a trading. So in these two situations, we can just adopt a gross profit margin analysis and adopt the resale price method comparison at GP level. Cost plus method. In terms of this, wherever the manufacturing capabilities, wherever semi-finished goods are being transferred internally or externally with related parties and unrelated parties, this is also a GP analysis, but this particular provision of services or sale of semi-finished goods or a manufacturing entity has to clearly derive at its direct cost and sales and arrive at a GP level analysis and internal GP versus external GP. But the gross profit that it has arrived at with internal transactions and external transactions has to be clearly specified. This is also a GP analysis. So the basic criteria of applicability of the resale price method and cost plus method, both are the gross profit level analysis. CUP is a transaction level analysis at the unit price level. It does not deal with any gross profit or net profit. It is the transaction value or unit price level. Now, profit split method is one of the complex methods out of all the 6 methods. Wherever there is intrinsically linked transaction, wherever there is complexity and we are not able to arrive at whose involvement or whose profitability in terms of a combined methodology. Say suppose a particular bridge has to be built in Delhi. The architectural capabilities are being brought from Australia. The infrastructure capability or funding is being done from China, and US is actually doing the entire branding and marketing. So in terms of all these 3 activities put together, and a brand like Larsen & Toubro India is actually implementing this particular project. So implementation capabilities, architectural capabilities, funding, branding and marketing, all these things put together, the project gets completed. Now, 5-6 entities from 5-6 jurisdictions have contributed to that particular project. In terms of these examples, where there is functional contribution in each of the departments, then in such a scenario, the profit split method would be adopted, where there is no clear bifurcation or there is no clear credible information for us to bifurcate the profits. In terms of that, generally profit split method is widely adopted where there are no other comparables that are available for such transactions, or the profits cannot be benchmarked that easily. So in this particular situation, how does the authority or the companies adopt profit split method? They go by the weights approach. What is the weight of the particular contribution from Australia? What is the weight of particular contribution from China? What is the weight of particular contribution from US? And what is the weight of the implementation that has happened from India? So if the weights are being determined in terms of the overall contribution, then the profits get allocated based upon tier 1 and tier 2 allocations of such weights, and then only the profit split method can be adopted and implemented. Transaction net margin method is a net profitability analysis where the search of comparables is being done by both assessee and also the transfer pricing office in terms of comparability analysis of or the comparable net margin analysis. This is the most famous method that is adopted for benchmarking purposes. It can be adopted for services, manufacturing, or wherever that net profit analysis is coming into picture, where the profit level indicators are OP by OC or OP by OR in terms of the revenue transaction and purchase transaction. Transaction net margin method is the most adopted method. And other method normally is a method where you can adopt a transaction that would have happened, but it has not actually happened. The difference between CUP method and other method is that CUP method, the transaction should have actually happened for you to compare. But for other method, the transaction need not actually happen. It can be determined based on a quote. It can be determined based upon the valuation report. It can be determined based upon a standard rate card. So these are the transactions which would have happened. And if at all I would have taken up this transaction, this is what I would have incurred. If such kind of information is available, then we can adopt a other method, which is a residuary method out of all the 6 methods that is available. So these are the 6 methods in brief and their applicability in specific scenarios and the methodology that is generally adopted. Now coming to the ALP part. Now how do we adopt the comparables in terms of the overall scheme of things, the transactional net margin method that I generally spoke about, the 5th method. How do we do the search process? If at all we are adopting a particular method for comparability analysis, the comparables are generally being split or adopted by a functional analysis and also application of quantifying filters and qualitative filters. Now, these are the 3 basic databases, Kaplan, ACE, and Probis, where we go for the transfer pricing comparability analysis. We select the industry, we select the quantitative filters, which are mentioned here on the screen, and we finally come back to the qualitative filters after removing or avoiding the companies which are not satisfying the quantitative filters. Then arrive at their profit margins for the last 3 years because of the multiple year notification. I'll come to that. And then finally arrive at the final list of comparables. So there is a sequence in which we actually arrive at the comparables while performing the comparable search in the transfer pricing databases. So this is the overall flow chain of the comparability analysis that actually goes through for the transaction net margin method or for resale price method, where comparables are to be adopted from the public domain or the transfer pricing databases. Now, the arm's length range concept, which I was talking about, has been introduced through a notification on 20/2015. And this particular notification talks about the application of a range concept, which I was talking about, the 35th and 65th percentile of the data set. For this applicability, specifically, there has to be minimum 6 comparables, and the applicable methods are TNMM, RPM, and CPM. The weighted average of the 3-year data of the profits have to be taken in year 1, year 2, and year 3, and it has to be arranged in an ascending order in terms of the profitability, and 35th to 65th percentile of the data set in terms of statistical analysis has to be taken. And if the tested party, if the assessee's margin is not falling within 35th to 65th percentile of the data set, then you are not subjected, you are not within the arm's length range, then that adjustment will be made from the median of that data range to your transaction price. So our margin, the assessee's margin, has to be between 35th to 65th percentile of the data set. Otherwise, we are not within the arm's length range. The transfer pricing adjustment could be computed from the median of that particular range. Now, what is this range concept that I'm talking about? Why is this so important? If at all, I am applying a particular transaction method and I'm saying 30 rupees is my transaction, and the market data is ranging between 25 to 45. Then in such a scenario, whether 30 rupees is falling within that range or not, and whether that broad range of 25 to 40, if you have data points, then you have to do a 35th to 65th percentile, and this 30 rupees has to be fitted into that particular range. If at all it is not falling within that range, then you are not called to be falling within the arm's length range, and you will be subjected to a transfer pricing adjustment from the median of that data set that I was talking about, from 25 to 40. This range concept is introduced from 2015, and the applicability, as I told you, minimum of 6 comparables have to be there. What happens if minimum of 6 comparables are not there? Then you will fall back to the plus or minus 3% that I was earlier talking about. So only if and only if there are more than 6 comparables, then only we are subjecting this particular entire data set for a range concept. Use of multiple year data. Earlier, before 2016, 2015, most of the entities or most of the companies used to go for a single year data. But now, most of the MNCs and the transfer pricing authorities have also shifted to multiple year data post this notification. So minimum of 3 years operating profit margins or 3 years gross margins are required to be analyzed before arriving at any kind of transfer pricing arm's length mechanism or transfer pricing arm's length range. So other than the current year, the previous 2 years data has to be analyzed. So the transfer pricing documentation. Now, as I told you earlier, there are two compliances. One is transfer pricing documentation. Other thing is Form 3 CEB. Now look at the transfer pricing documentation. What is the threshold limit of transfer pricing documentation? Minimum 1 crore international transaction with the international related party has to happen. Then only Rule 10D documentation is applicable. Now there are 13 clauses in this Rule 10D documentation. The first thing is the basic entity related information, which is the basic stuff like ownership structure, profile, and business description. But the other parts, which are called as price related information, would require nature and terms, description, records, and any other description of the method that you chose for justification. So you need to give the transaction details as well as give them a record of analysis, and also determine under which method have you determined this analysis and how are you benchmarking. This is how the documentation has to be built up. Other than that, if at all we are having any other details like functional analysis and the budgets and forecasts, and also which will justify the overall transactional flow and also justify the benchmarking analysis, has to be reported and documented in that transfer pricing documentation. This is not presently required to be updated or filed online. And this is only applicable if at all we are crossing 1 crore international transaction value. This has to be maintained as on the date of filing return of income. Now, coming to Form 3 CEB. 3 CEB is the Chartered Accountant certificate that requires to disclose the transaction values. There are three parts in this Form 3 CEB. Details of the taxpayer, details of the international transaction, and details of the specified domestic transactions. Taxpayer details normally are the PAN, assessment year, the ownership structures, and the basic level details. But details of the international transactions specifically ask for any kind of services, tangible, intangible, guarantee, loan transactions, or any other residual transactions that you are having with your related parties. For specified domestic transactions, if you are having any transactions with a tax holiday claiming entity, then all those transactions have to be disclosed. These three parts are specifically divided, and all these three parts have to be filled up. In terms of the certification is concerned, it is true and correct. It's not true and fair view. It's a true and correct view. So all the transaction values, the methods, and the transfer pricing documentation has to be there before we file any Form 3 CEB. Now, as far as this Form 3 CEB is concerned, there were some recent changes that have happened, which would require the tax identification number and any unique identification number that has to be disclosed as part of the Form 3 CEB of the related party, the global related party. Earlier, it was not a requirement. Along with the transaction values and the method and the description of the transaction, there is a specific requirement from this assessment year for FY 2021. This particular TIN or unique identification number has to be punched in, or otherwise the form is not getting validated, and there are a lot of errors while filing. Now, till last year, there was an offline utility to file the Form 3 CEB. From this year onwards, they have not actually encouraged the offline utility for some reason, which is very, very unfortunate from the government standpoint. But if a entity has 45 to 50 transactions, then you have to punch in everything. So for each clause, they have given a specific module or specific format of Excel, which you can download and report all the transactions and import it back to the utility or the online filing mechanism. So please make use of that, and also make sure that you are having the tax identification numbers of the global entities before in hand. So February 15th might be the deadline. So please make sure that the Form 3 CEBs are all reported, and any kind of validation errors. Also, there is a problem that it is not specifically showing where the exact error is happening. So all these have been summarized. We have rolled out an alert, which is available in the public domain, where specific FAQs or a specific functionality problems, or this particular TIN development, or the offline utility not being available, all these things have been reported in that alert that we have prepared. It is available in the public domain. Any problems in this particular regard, you can always reach back to us. Now, evolution of transfer pricing, mostly the main amendments have started coming from 2012 onwards. The definitions have all been amended in 2012. 2013, the tolerance range that I was talking about, the multiple year data and the specific range concept has been introduced in 2013, 2014. Now, coming to the SDT transactions, as I told you, they have increased the threshold limit from 5 crores to 20 crores in 2015-16. And also in 2016, the 3-tier documentation, master file, CBCR, and local file. Local file was always there, which was called as the transfer pricing documentation. But the master file and CBCR have been introduced in India in 2016. I will take you through the threshold limits, when it is applicable, and what kind of details are required to be uploaded. We will go through these master file and CBCR, but 2016 was a landmark year where India has adopted a 3-tier documentation to be maintained for transfer pricing purposes. Basically, for CBCR to be applicable, it is around 5,400 or 6,400 crores, and master file to be applicable, it is around 500 crores consolidated turnover. So these are the segment in which these the threshold limits or volumes in which these 2 additional documents would come into picture, other than the Form 3 CV and TP report. Now, in 2017, a lot of changes in terms of secondary adjustment and limitations of payments and all have come. I will take you through these 3 things: master file, secondary adjustment, and limitation of interest payment. The secondary adjustment is concerned whenever a particular transaction is determined to be not at arm's length. Say, suppose I have dealt it 35 rupees and the arm's length has come up to only 30 rupees. What should I do? Can I report a voluntary TP adjustment? Yes, I can report a suo motu TP adjustment. But if at all the volume of such 5 rupees into so many transactions, or 5 rupees into so much quantity, is exceeding 1 crore rupee, for the secondary adjustment to kick in. What is the secondary adjustment is? The primary adjustments are these things. Wherever I am disclosing myself as a primary adjustment, I am subjecting myself to a suo motu adjustment, and whether an officer is determining that primary adjustment, whether as per the safe harbor rules application, if I am not falling within arm's length price, whether as per APA also, the APA authorities have determined a particular price for my particular application and for my particular facts. And if I'm not in accordance with such pricing, then that particular APA authority or we can ourselves disclose that particular pricing or the adjustment and determine a voluntary TP adjustment. So in these scenarios, wherever I am disclosing my adjustment to be there in the income tax return, that my transaction is not at arm's length, then there might be a scenario that I'm crossing 1 crore amount, which would exceed the overall primary adjustment. In such a scenario, I am subjected to actually bring that money back into India. So wherever I have exceeded 1 crore rupee as a primary adjustment or a voluntary TP adjustment, then in such scenario, I have to get back that amount back into India, and I cannot do a notional adjustment to my income tax return just by offering a 1 crore or 1.5 crore over and above the actually derived cash flows into India. So they have just kept this tap because most of the entities have been taking advantage of this voluntary TP adjustment as a loophole, and they were just offering 30% of that element. Say, suppose I have offered 5 crores as a voluntary TP adjustment because my margin was less in that year. I would pay a 1.5 crore tax, this 30% of the 5 crore, and avoid getting the 5 crore back to India. So they have kept a tap on this particular aspect, and they have actually asked the entities to get 1.5 crore amount back into the Indian jurisdiction, because they were avoiding the foreign currency cash flows. Now, in such a scenario, if I am delaying the cash flow back into India more than 90 days, if at all it is denominated in foreign currency, then there is an interest imputation based upon MCLR plus 325 basis or 6 months LIBOR plus 300 basis points. Wherever it is denominated in INR, then it has to be the lending rate plus 325 basis points. So they have kept a tap even on the timeline in which the amount has to be brought back into India. As I was talking about the master file and CBCR, master file is a threshold. I'll just talk about the threshold limit first. So consolidated group revenue has to be more than 500 crore, and the aggregate value of international transaction has to be more than 50 crore. or the aggregate value of the intangible property related international transaction has to be 10 crore. So the combination of 500 crore global turnover, consolidated turnover versus 50 crore international transaction or 10 crore related party intangible transaction is a combination in which this Form 3C EAA master file would come into picture. This is for this volume companies. This is for only big companies that this data is asked for. Why this data? I'll show you the requirement of master file. What exactly are the components of master file? These are the components of master file. They would ask for your legal ownership structure. Who are the what are the best 5 products that you have, the largest supply chain products that you have, in which jurisdictions are you dealing with, what kind of service agreements are you having, what business restructuring transactions have you done during the year, how much intangible value you are having, where are you doing the R&D, where are you transferring that intangible property, what kind of financing arrangements you have with global entities, what is the transfer pricing policy that you follow, and any kind of APA arrangements that you have accepted with any government authorities across the world. So why are they asking so many details for big entities? Because they want to understand where are they parking the profits, where are they exactly doing the R&D, where are they exactly having substantiated transactions, where are they having employees. So if you go through all this at an India level, then whether they are using India only for a back office segment and taking away the entire hard work from India, or they're actually giving any value addition back to India, is what the Indian government wants to know. This is a format of the OECD, the basic pro forma, but they have made few changes in terms of R&D requirements and financing arrangements and specificalities of the banking arrangements. But other than that, most of the information is a global criteria, and India has adopted that OECD G20 framework only. So this is applicable for more than 500 crore consolidated turnover, 50 crore international transaction, and 10 crore intangible this thing. But the master file is applicable for many entities at Hyderabad level, but CBCR is much more bigger threshold limit, because the CBCR is applicable for more than 750 million euros, which is around 6,400 crores turnover based entities. But the CBCR concept also is the same concept, but it is a bit in detail because it goes by tax jurisdiction level. It actually asks for the specific numbers and specific details. So once you fill up these details, they'll be able to identify the number of employees, what is the actual profitability, effective tax rate of each jurisdiction, and how much profitability each jurisdiction is doing, what kind of revenues you are generating with related party, other than related party. So this is for an entity which is more than 6,400 crores. Now we'll just go through the forms that are actually there from a part A and part B is concerned. But the point that I'm trying to say is the part A, which the master file is required, this part A is applicable for all the companies. This has to be filed irrespective of the threshold limits. So part A, along with the transfer pricing documentation maintenance and Form 3 ECB online filing, part A of master file has to be filed. Only the part B would require this kind of compliance. The part B is the main quantitative and qualitative data that the information is seeking. But part A is generally the name, PAN, and which jurisdiction, what is the transaction, or where are you dealing with. That is a very basic data. But Form 3C EAA, part A has to be compulsorily filed along with Form 3C EB. So now let's get on to the other topics in terms of the applicability of various definitions and the recent developments as such. Mostly the Indian litigation has revolved around cherry picking of comparables in terms of the applicability of transfer pricing. As I told you, most of the litigation has been revolving around comparability criteria, whether a relevant comparable is really comparable to you, or a company floated in Hyderabad with 20 crores turnover is being compared with a Microsoft was the main criteria of litigation. But of late, there are plenty of judgments at High Court level, even at Hyderabad and Telangana High Court has also come up with these judgments. But the point that we are trying to establish here is cherry picking of comparables is no longer a litigation criteria. You can always adopt the specificality on comparison aspects and apply the relevant filters as we were talking about in picking of the comparables, and also seek information of how the TPO has arrived at. If at all he has arrived at any comparables without any kind of analysis also, then also the tribunals have been in favor of the assessee. So cherry picking of comparables and determining arm's length transfer pricing adjustment without any analysis is no longer a criteria of adjustment. Domestic TP, mostly 48(2)B amendments between 2012 and 2016 have been a matter of litigation. So in Hyderabad as well as in Bangalore, as well as there are Supreme Court judgments where they have clearly mentioned that SDT transactions in relation to the 48(2)B part can be deemed to have been omitted from inception. So the 2012 to 2016, whenever there are additions on 48(2)B from domestic transfer pricing scenario, can be avoided by quoting these judgments at a tribunal level or from a high court level. So this is deemed to be omitted from inception. Marketing intangibles, wherever we are using the intangibles of the foreign entities and predetermining these intangibles for the usage and making sure that we are promoting these brands, foreign brands in India by trading these products, then the litigation is that the transfer pricing authorities have been subjecting these kind of advertisement, marketing, and promotion expenses to a litmus test called as the famous AMP adjustment. So they are asking for a litmus test to be proved whether you are expending these advertisement, marketing, and promotion expenses over and above the comparability threshold. Say suppose there are in an electronic industry, if a particular company A is expending advertisement, marketing, and promotion to be 5% of the overall operating or manufacturing costs and sales, then in a comparable situation, if the other traders in electronic industry are only expending 1% or 0.5% of their overall manufacturing costs or sales, then the 4.5% has been subjected to a transfer pricing adjustment, because they have determined that you are promoting a foreign brand here in India and making sure that their sales are getting increased. So you're actually promoting a foreign brand by incurring this AMP expenditure. So that is how the derivation of this AMP adjustment or the entire litigation has happened. But of late, this kind of adjustments have put on to a full stop, and they have been clubbed in the overall TNMM analysis or in the profitability analysis. But still the litigation is on, and a lot of confusion is there in and around this subject. But please make sure that these judgments are throwing a very good light and they are given a very good guidance on this particular aspect. But still, if at all there is AMP expenditure, and if that documentation or benchmarking has to be done, we plan it before closing of the financials or before closure of the Form 3CB itself. Otherwise, there's going to be a huge litigation when this particular topic gets picked up during the course of transfer pricing scrutiny. Whenever there is a guarantee on behalf of the AE issued by the Indian entity, then in such a scenario, whether the Indian entity has to take guarantee fee or do not take any guarantee fee. Most of the Indian entities do not take any guarantee fee, and they argue that it is a shareholder activity, or they have given it on behalf of the subsidiary, and it is only a shareholder kind of a signature or a paper documentation that they have given. They have actually not incurred any kind of guarantee fee. So in such a scenario, whether guarantee fee has to be charged by the Indian entity from the global subsidiaries was a big matter of litigation. In such a scenario, whether guarantee transaction itself is a international transaction or not was one of the questions that was asked for the tribunals and high courts. Now the issue seems to be settled, and they have all adopted a case where the guarantee transaction is an international transaction. However, if the transfer pricing authorities are not doing an economic analysis and not deriving at the benefit test that the Indian entity is or the group itself is getting because of that guarantee, and there is any fee or any expenditure of the Indian entity on because of this transaction, then only a guarantee fee has to be charged from the subsidiary. Otherwise, there is no requirement. If at all the TPO is doing any kind of adjustment on this topic, then the assessee can challenge him to do a proper economic analysis. Without any proper economic analysis, if the TPO is only adopting 133(6) information from the local private commercial banks on what charges are they taking for corporate guarantee, then that is not a relevant comparable at all. So this particular analysis has been upheld by various high courts and the recent tribunal rulings of the entire South India. But the point that we are highlighting here is, please be very specific on the guarantee transactions. Whenever there is a guarantee transaction, there is a liability clause in the notes to accounts or in the contingent liabilities, please make sure that the subject transaction is getting reported, because the Form 3CB specifically asked for disclosure on these guarantee transactions itself. Notional, interest imputation on outstanding receivables. How much interest on outstanding receivables has to be charged, and what is an exact credit period? Say, suppose I have raised an invoice in July and I have not received it till March. The actual realization period as per GST or as per FEMA is not more than 9 months to 1 year. If at all you are crossing that 9 months to 1 year, then there are subject specifications or challenges from GST standpoint, not considering that as an export, or from a FEMA standpoint, the reporting requirements, or from a permission requirements or approval requirements from RBI. But from a transfer pricing perspective, if at all there are any realization delays, then transfer pricing authorities have been behind the assessees for interest imputation on such receivables criteria. And even in Form 3CB or the Income Tax Act definition of the international transaction, there is a specific disclosure that is required on the outstanding receivable part. So these outstanding receivables have to be specifically disclosed, and they have to be reported in Form 3CB as well. And the delay or the number of credit periods from the date of raising of invoice to the date of receipt of money, how much credit period is being given to the your related parties has to be tracked. If at all it is beyond such credit periods or 90 days or an average credit period of the industry, then it is better to charge interest, or you have to prove that the transfer pricing policy of the assessee is that they do not charge interest from both AEs and third parties. They adopt a single philosophy that they never charge interest from both related parties and third parties. This is the overall scheme of litigation on the interest on receivables component on outstanding receivables. So please be aware that the reporting has to be done on outstanding receivables in Form 3CB, and a relevant benchmarking also has to be adopted. It is also better that a working capital adjustment or a imputation mechanism on the entire current assets and current liabilities is being plotted. And if you are able to report it back, that even after any delay that the assessee has from the parent entity, it is charging a very good and high margin as compared to the industry. After the working capital impact also, then there might be a leeway in the transfer pricing documentation during the assessment. So please make sure that the relevant disclosures are made in the transfer pricing documentation. So in terms of management fee, fees for technical services, or any kind of payments that the Indian entities have been making to the foreign entities, the question that has been asked is on the benefit that is derived by the Indian entity in relation to the commercial rationale of that business expenditure. If an Indian entity is making a payment of a management fee or a fees for technical service to its global entity as a cost sharing arrangement, global entity is monitoring the entire subsidiaries across the globe. So they have incurred 1 crore rupee in relation to the management fee, top management fee. Nowadays, because of COVID, nobody is traveling, and the management has incurred from there itself. The salaries of top management have been allocated to various subsidiaries. Now, Indian entity's share of that overall cost sharing agreement is 2.5 lakh or 25 lakh rupees out of that 1 crore that we are talking about. So 25 lakhs, when the Indian entity transfers at the end of the year to the global entity, transfer pricing authorities have been asking questions on the benefits that are derived by the Indian entity in relation to that 25 lakh expenditure that you have incurred. If you are not able to prove what kind of benefits that you are receiving against such payments, then the litigation of proving that entire aspect of benefits is called the benefit test analysis, where specific questions have been asked to prove what kind of benefits you have derived, whether there was an increase in the turnover, whether there was an decrease in the expenditure, efficiency levels, process know-hows, trainings, what kind of support that you have got from the global entity is what you have to document and show it to the tax authorities to justify the payment that you are making to the global entities. This is why this particular litigation has come in is most of the Indian entities have been transferring funds back to parent entities and global entities to avoid dividend distribution tax earlier. So they used to transfer the funds as a business expenditure or any fees for technical service without any deduction or withholding taxes as per the DTA benefits. And they used to claim expenditure by making some agreement. But the tax authorities have been questioning these amounts, and they have been behind the SSCs to prove that what kind of benefits have you derived in by making these kind of payments. So this is the exact litigation that has happened. So SSCs or the auditors have to specifically document what kind of benefits or the commercial rationale that the company has got from the global entity. What kind of justification we have for the entire expenditure that we have booked for against the payments that we are making to the parent entity. Compensation of intra-group services. This is what these are the famous judgments that are substantiating the SSC's claim. But the penalties, if you ask me, if at all there is any deviation of the disclosures, if at all there is any deviation of the entire scenarios of the assessments, there is a penalty section. These are the penalties that we have, transfer pricing penalties. What kind of underreporting, if at all any underreporting or misreporting happens, the penalties are 50% or 200% of the income volume. If at all there is any concealment is concerned, 271(1)(c), there is 100 to 300% of the adjusted amount. If at all we are not maintaining the transfer pricing documents, then 2% of the international transaction value. If at all we are not furnishing the relevant report, when asked for during the course of assessment, transfer pricing authority can deploy 2%. If at all we are not filing Form 3CB, there is a 1 lakh penalty. If at all we are not maintaining any entry in the books of accounts and it is just being transferred, then the amount is equal to the false entry. If I am not filing the master file or CBCR, then there are huge penalties up to 5 lakh rupees. So these are per day, per month kind of scenarios for CBCR. But if you are not filing the master file, which is applicable for 50 crore or more international transactions, then there is a huge penalty of 5 lakh rupees. So this is a summary of the transfer pricing penalty provisions is concerned. Now we'll come to the assessment procedure. What generally happens in transfer pricing, what challenges we face, and what are the alternative options for us to go for an appeal. Now, whenever a case gets referred for a transfer pricing authority, there is a specific notification now. Earlier, there was a threshold limit of 15 crore above. All the entities which were crossing 15 crore above were mandatorily referred to the transfer pricing office. Now they have removed that threshold. They have kept a risk parameter kind of a tab where specific notification 3/2016 has been adopted. And this particular notification talks about risk parameters. Whenever there is non-disclosure, whenever there is a previous adjustment of more than 10 crores, whenever there is non-compliance, whenever there is a belief by the authority that there is a risk of revenue loss to the department, in such kind of scenarios, the assessing officer can refer the matter to the TPO. Or the risk, the computed scrutiny selection can also pick you up if your margins are lower. There are almost around 350 parameters in which your data of financials and ITR is being tracked by the computed scrutiny selection. Out of this, the 5-6 reasons that I have mentioned are the primary reasons. Other than that, any kind of related party transactions not being reported, any kind of related party transactions being underreported in terms of the volumes, in terms of the profitability also might be the major reasons for selection of TP assessment. When the TP assessment reference goes to the TPO generally passes the order within 6 to 9 months of its reference from the date of reference to the order. Once the TPO passes the transfer pricing order, if the order will go back to the jurisdictional AO, now at NFAC, the National Faceless Assessment Team, and this particular AO will pass a draft assessment order, giving the authority, giving the assessee a time of 30 days to select whether he wants to go to a commissioner income tax appeals or to the dispute resolution panel. For adjustments which are subjected with transfer pricing or international tax scenarios, there is a specific obligation on the assessing officer to give him a practical timeline of 30 days to go for a dispute resolution panel route other than the CIT appeals route. So dispute resolution panel has a time of 9 months to evaluate from the date of filing to decide on the matter. And over and above that, if once the DRP order is passed, if it is in favor of the SSE, it is well and good. If it is not in favor of the SSE, then the SSE can go to the ITAT after that, which is the Income Tax Appellate Tribunal. The other route, which is the CIT appeals and ITAT route, most of you might be aware. But in terms of the transfer pricing matters, there is a specific timeline of 30 days and an alternative mechanism of DRP is also provided for the litigation process in transfer pricing. Now, under the faceless assessment scenario, whether this particular transfer pricing assessment would go for a faceless kind of situation or physical situation. Presently, even after the announcement of NFAC, for the last 2 rounds of assessment, the assessments are still happening in the jurisdictional cities or jurisdictional transfer pricing units in their relevant jurisdictions. But in the future, there is a chance that this might be referred to the technical units, which are still yet to be formed. Once these technical units are formed, all the assessments would be referred to these technical units and it would be subjected to a review by the technical units itself. So the National Faceless E-Assessment Center, there are 4 units: assessment unit, verification unit, technical unit, and review unit. This transfer pricing unit might fall under the technical unit and which is yet to be formed. And thus the current assessments till next year also might be under physical mode only for transfer pricing. But in the future, once the technical units are formed, this might be moved to technical units under the NFAC. In terms of the dispute resolution mechanisms, the government has come up with a safe harbor notification where, referring to a specific methodology or a specific transaction, they have defined the transactions, they have defined the threshold limits, they have defined the margins to be maintained. And once the SSE is adopting to these safe harbor provisions, then the government would levy that SSE or leave that SSE from any kind of assessment. So this is the entire schema of the safe harbor. If at all anybody wants to adopt to the safe harbor, first they have to fall within the definition of the transaction. In terms of the income tax provisions of safe harbor, there are specific definitions which are given for software, ITES, R&D, and the specific loan transactions, and the threshold limits being mentioned, whether they are below 100 crores or below 200 crores, and whether the loan transaction is foreign denominated, local denominated, and these kind of bifurcations are provided. But once you are falling within those definitions, the application has to be made to the AO, and the AO will refer the matter to the TPO, and TPO within 2 months will give an approval. Once that approval comes back to the AO, then you would be assessment free for a period of 3 years or so. But this particular concept has not been a very famous or successful concept as far as Hyderabad and Bangalore is concerned. But from an alternate dispute resolution mechanism, the other famous mechanism and very successful mechanism is the APA. In terms of the APA, there are 3 types of APAs which any SSE from India can file: unilateral, bilateral, and multilateral. Unilateral APA is the advanced pairing arrangement concept where the SSE can file a application to the government seeking for the margin negotiation or seeking for the margin finalization from the government standpoint. They do not want any litigation with the government. So an SSE has gone to the government and asked, this is my transaction. I'm a software service support provider from India, and these are the number of employees. This is what I exactly do. You come for a site visit to my office. You determine the margin. You tell me what margin to be maintained. I'll maintain that margin for 5 years. So the department is ready to leave the SSEs for 5 years if at all there is an advanced pricing agreement signed with the government from the Delhi level. So this is the unilateral APA with the Indian government. Bilateral is cross-border. Both the competent authorities of 2 countries, India, US, India, UK, India, Japan. These are the 3 famous jurisdictions which have mostly dealt with the bilateral APAs. So 2 jurisdictions, competent authorities talking to each other. This is similar to the mutual agreement procedure, but the bilateral APA is more faster and more effective, and it does not create any conflict with the other jurisdiction as well, because both the governments are involved. So there won't be any transfer pricing litigation further. So this is the best solution that anybody can go for if their volume is very big and their future plan is very big. In terms of tenure, we get a 5-year moving forward and 4-year rollback. So 9 years we can secure without any litigation in an advanced pricing arrangement scenario. MAP, most of you might be knowing, there is a competent authority as per Article 25 of most of the DTAs. There is a specific mutual agreement procedure which can be adopted, and competent authority of India can negotiate your transaction or the international transaction situation with the other competent authority across the globe and determine a resolution or a settlement and seek your comfort on that particular adoption of MAP and implement that MAP along with the jurisdictional AO. This particular MAP would be applicable only for the SSE who applies, adopts, and negotiates this MAP along with the competent authority. EP penalties we have covered. Now we'll come to the due dates and practical difficulties and the recent developments that have happened. Now, in terms of the due dates, actual due date from a transfer pricing law standpoint or income tax standpoint, the additional 1 month timeline or 2 months timeline is given from September to November. Normally the income tax due dates are September and November. Till November, why the 2 additional months time is given is for preparation of transfer pricing documentation, analysis and all. So they're normally giving you that 2 months timeline. Because of COVID, it got extended. This is the 4th extension, I believe. Now, 15th February 2022 is the final deadline, maybe for the transfer pricing filings and the documentation and the compliances. An additional 1 month again is provided for master file and the files where the Form 3CA has to be done. So 15th February and 15th March for master file. In terms of the CBCR and the implementation or adoption of CBCR is concerned, the intimation filings and the alternate reporting filings of the parent entities have to happen by 31st January 2020, which is very near, and 31st March 2022 filing of the CBCR by the Indian parent itself. If anybody else is reporting, I'm only intimating, then that is different. If I myself am the parent entity and I am filing the CBCR, then it is 31st March 2022. Now, as we have seen in the above slides, the detailed documentation in terms of effective tax rates, revenues, related party transactions, third party transactions, intangibles, all have to be disclosed as part of the CBCR, if and only if you are crossing 6,400 crores. Now, going to the global scenario where what is happening at the global level, and these are the recent amendments that we can expect to happen in this budget, which is coming up as per the transfer pricing. This is the evolution of the OECD, what they have been planning to do or avoid a double taxation or avoid a scenario where any entity is escaping taxes just by taking a loophole in the DTA, advantage of a loophole in a DTA. From ever since 2013 to 2021, they have been continuously working, and this is one of the mother organizations where the international tax and transfer pricing concepts and the evolution mechanisms have come up. Now, recently, they have come up with 2 pillar statements. One is pillar 1 and pillar 2. This is basically out of the 15 action points that BEPS has announced in 2013. 15 out of the 15 action points, the 2 basic pillar approaches of the framework have been pillar 1 and pillar 2, where pillar 1 talks about a taxing right or distribution of the taxing profits. In terms of pillar 2, the basic minimum taxation criteria and the jurisdictional simulation criteria, where different operating models are adopted by different jurisdictions. Now we'll talk about pillar 1 and pillar 2, and this might come in very fast because of the evoluting scenarios. Now, when we are talking about pillar 1, it is basically a online kind of a scenario where digital services or consumer facing models and any kind of distribution activities happening online, and these are Amazon's, Flipkart's, Swiggy's, and the cryptocurrencies, everything that is coming in very rapidly into the business domains. So automated digital services and consumer facing businesses which are having a threshold limit of more than 20 billion as a global turnover, and a profitability of more than 10%. This is the global threshold limit, the entire global consolidated level, and the local level, that is at India level, if at all their revenues are more than 1 million euros, and for GDP countries, it is 2.5 million euros. In terms of this local revenue, this is the threshold. In terms of the global threshold, this is the overall, global threshold. If these two thresholds are satisfying for these kind of assessees in terms of automated digital services and consumer facing businesses, then the taxing rights in terms of who wants to tax what and at what rate they have to segregate the revenues and taxes, and at what ratios this allocation has to happen, and how to track the actual owner of this particular business and how to distribute the taxation of this particular revenues is the challenge of the global taxation authorities. Now, in terms of the real-time locator of these particular automated digital services, the IP addresses and geolocation of the operators are very important. And in terms of the consumer-facing businesses, who is the licensee and franchisee? If at all I am the licensor and the other person is the franchisee, the licensor will be the main guy and franchisee will be the sub-licensed guy. So now coming to the actual computational mechanism, what generally happens, what is the intent of this pillar one and amount A that we are talking about? Say suppose an entity which has earned 25,000 euros at a global consolidated level, and its profit is 6,500 euros. Now, its profitability margin is 26% as per this particular assumption or illustration. Now, coming to their allocation of turnovers, the turnovers are generally around market 1, 2, and 3, where the 25,000 euros has been split into 3 jurisdictions, and there is a local subsidiary and the remote activity players market 2 and market 3. Now, this is the factual scenario. Now, how to allocate the taxing rights of these 3 jurisdictions? Who is involved in what, and what are the taxation criteria? Now, they have determined 10% to be the minimum routine profit that any entity in these kind of automated digital and marketing entities and consumer facing businesses, minimum of 10% margin has been accepted and believed to be the thumb rule. Now, out of the entire profit of 6,500, they actually have calculated a residual profit in this way. They wanted to calculate a residual profit, which is W in this example, which is profit 6,500 minus residuary profit of 10%, which is 22,500, 25,000 into 10%. So on the total revenues, if you are having a 10% residual threshold, which is a routine profit, then the residual profit of 4,000 is actually arrived at. So routine profit and residual profit have to be allocated after removing 10% of the threshold limit, and this 4,000 residual profit will be arrived. In terms of reallocation percentage, what generally happens in amount A, 25% of this values, what we are calling as a non-routine profit, out of the 6,500, 2,500 has been removed. Now out of the 4,000 also, 25% non-routine category has been arrived at. So once we arrived at the residual profit, 25% is reallocated and amount A is established. So we have to understand the activity test, profitability test, market connectivity test, and pro rata allocation test in terms of eliminating any kind of double taxation scenario. So wherever there is involvement of 3 or 4 jurisdictions, first we have to arrive at the residual profit and then go for the reallocation percentage of 25%. Now, how do we allocate it back into these jurisdictions as per the pillar 1 concept, or as per the amount A concept that this pillar 1 has suggested, is based on their turnover ratio of 8, 72, and 20. Now, in these 3 markets, these are the revenues. This is the percentage in which the revenue has come up. Now, the 1,000 rupees that we want to reallocate it back to the jurisdictions, as a amount A will go back into their jurisdictions as a turnover ratio, and this 1,000 rupees will get reallocated back. So the allocation key here has been taken as a eligible market jurisdiction. So most of the allocation keys as a paying entity has to be allocated based upon activity, profitability, market connectivity, and pro rata allocation. Pro rata allocation is residuary, but rest of the three concepts in the hierarchy manner, in the hierarchy of indicators has to go in, and this has to be reallocated back into the jurisdictions. Why this kind of concept has come is most of the entities are just disclosing as per their will and wish by creating documentation stating that this is the franchisee, this is the owner, this is where the local jurisdiction is coming into picture. So they want to reallocate the entire profitability into the respective jurisdictions based on a particular sequence of hierarchy of indicators. So the intangible or the automated digital service and consumer financing businesses will be subjected to a specific computational mechanism going forward, and India may adopt this very soon. So how to arrive at the tax certainty and implementation as per this pillar one is mostly dispute resolution by creating panels, and this kind of discussions and mutual agreement procedures also will come into picture very soon at a global level, and India is fastly moving towards discussing these kind of prevention and resolution panels. And also the pillar one requires a lot of changes in the domestic law, and even constitutionally also there might be a lot of changes that might be required to amend and bring this to a implementation stage. It might still take 1 to 2 years for India, but very soon this might come into picture. Now, global minimum tax rule. This is also very important, pillar 2 or the amendment that might come in. Nirmala Sitharaman has already spoke about this in the our press interviews and other things, that India is looking to implement this minimum tax rule. Most probably it might be around 15%. What is this minimum tax rule is? Any M&E which is crossing this 750 million threshold as a globe, as a turnover, will be subjected to this 15% minimum tax rule. That is, say suppose India has a huge group, and Indian parent company has subsidiaries across the globe where the taxation is below 15%. Say suppose Dubai or Netherlands or Ireland or any kind of jurisdiction where they have selected the income streams in such a way that the effective tax rate is less than 15%. So in such a scenario, India would be subjecting to those incomes in a consolidation level back, and India would be subjecting these incomes which are not being subjected to tax in the local jurisdictions with a minimum base rate of 15%. So this is the minimum tax rule that India would adopt for all its global subsidiaries. Similarly, there are almost around 40 to 50 countries that have already signed, and there is a lot of attention at the global market, and even Dubai has accepted this global anti-base erosion, which is a minimum tax rule. If at all it is subjected to withholding tax, if at all it is subjected to taxation above 15%, then there is no problem. If at all it is below 15%, then India or the resident countries will come up with this kind of minimum tax rules to be implemented. So similar to MAT credit, similar to carry forward rules that we have in our income tax law, there are rules of excess tax carry forward. There are rules of loss carry forward also in these minimum tax rules. There is specific carve-out scenario for any kind of improvements that we do to our subsidiaries in terms of tangibles, in terms of assets and payroll. A minimum carve-out of 5% and 10% is provided to these kind of carve-outs. But mostly these entities would be subjected to a minimum rate of 15%, and these globe rules won't apply to government or international NPOs and pension funds. But this particular rule will impact mostly companies that have already planned their subsidiaries and step-down subsidiaries in a low tax jurisdiction. So it is high time that you start evaluating whether these globe rules are going to impact, and are we going to shift our revenues, or we want to shift our business plans to a minimum tax paying entities like Singapore or Netherlands or UK, where minimum tax of 17, 15 and 13 or 14 is being there, so that we avoid attention among this minimum taxation rules. Subject to tax rules, if at all, if there is any withholding that is applied or any taxation that is applied as per the treaty benefits or local taxes, then this particular globe rules or minimum tax rules won't apply. But if at all this particular exemption is being claimed, then there has to be a reporting also as per the subject to tax rules. Now, whenever there is a permanent establishment from India, and in such a scenario where this particular minimum tax rule is not being applied, then also there is a specific requirement of switch from an exemption. And say suppose that permanent establishment is in Dubai kind of a jurisdiction, then the permanent establishment revenues which are getting consolidated back to India also will be subject to a minimum effective tax rate of 15%. So this is the global pointer P2. In the recent OECD guidelines, this is the last of the topics, where the recent guidelines have been changed 2 weeks or 1 week back. The main topics of this OECD guideline, transfer pricing guidelines changes are that financial transactions, which are mostly cash pooling, loan, and any kind of treasury kind of functions, guarantee kind of functions, examples and capital structure and interest deductibility rules have been specified, and the risk-free return and risk adjustment rate of return on guidance has been provided. And we'll come up with an alert on this particular 2022 TP guidelines. But on the transactional profit split method perspective, earlier it used to say that any transaction which is intrinsically linked and IP related transactions, only profit split method has to be used. But now the guidance has been expanded, and they have clearly specified examples and guidance theory where profit split method has to be used. They have clearly mentioned if at all comparables are not there, then you can go for profit split method. Then also they have mentioned unique and value contributions are one of the criteria to go for a profit split method. And they've also specified how the highly integrated contributions have to be deregulated and reliably evaluated in an isolated manner. So very good guidance on these two topics has been provided. But this impact on India might come not very, very soon, but it might come within 1 to 2 years. So mostly these guidelines are just throwing light on the previous litigation and previous non-clear items, but no major impacting changes that might come to India very soon. Any questions, any kind of practical things that you want to discuss? We are open now, so do let me know.
Thank you, Mitresh. Mitresh will be here only now till the task is completed.
Is there one question in Q&A section?
Oh, right. We have one question. CA Nitin says, Mitresh, would transactions between a company having head office in India and branch are pricing?
See, once that branch is filing a specific income tax return in that particular jurisdiction as a permanent establishment, if you are disclosing that as a permanent establishment on the other side, then there will be a clear bifurcation of the transactions. And also the branch office is called as a specific other identity, because you will be taking the local TINs, you will have a separate identity there, and you will be dealing with that as an international scenario itself. It is better and conservative view that we are following from the initiation is that the branch transactions also will be disclosed as an international transaction party only. But make sure that on the other side also we are filing the income tax returns and all, because overall situation is that in terms of the branch transactions, the basic question will be on the profitability of that particular branch, because attribution of profit of that branch would be the major subject matter because of the local jurisdiction that their governments would be asking it. So answer is yes, you have to disclose and document. On the other side, also take care about the profit attribution of the branch in those jurisdictions.
Yeah, thank you, Mitresh. Members, any more questions?
One more question.
Yeah, no more. Mitresh, with your permission, can we proceed to tax audit?
Yes, sir.
Would you like to stay here for some time?
I'll have to leave, sir. I have something planned. So if any questions are there, I'm always available. My mail ID, phone number, everything is there.
Yeah.
Yeah.
Then you
Thank
can
you,
share
Mitresh.
the certificate, Satish.
Yeah, it's our precious time to give vote of thanks for this first session. Thank you for accepting our request to address us and for your wonderful and what do you say, lucid presentation actually. Most of the members giving compliments in the chat box, we can observe. Almost after 1 month or more than 1 month, we arranged this meeting. On behalf of our branch, we sincerely thank you for accepting the request. ACF, can you please present the certificate you have with us? Do you have ACF?
No, I don't have.
Yeah, just 1 minute. Yeah. I'm taking out. Nitesh, can you please close the screen, please? Thank you. Kindly accept our virtual certificate of application, Nitesh.
Thank you, sir. Thank you so much. Thank you.
From Hyderabad branch.
Thank you so much,
It is
sir.
only for the time being. It will be delivered to your address, sir.
Yeah, in physical mode.
Thank you so much, sir.
Thank you, Mr. Thank you.
Thank you so much.
Yeah.
Thanks.
Yeah, Rajesh, if you want, you can take some break or you can start.
Start, sir.
Yeah, please.
I hope I am fairly audible and visible.
Perfect, sir.
Yes.
Okay. Is my screen visible, sir?
Yes.
Okay, great. Good evening, everyone. First of all, I would like to thank all the dignitaries and the members, honorable members, for giving us the opportunity to present on these matters. While tax audit, there has been an extension already, and most of the filings we were anticipating to get completed by earlier due date, but there has been an extension due to the practical challenges and the website related issues which we have been facing. So I feel that this is very much relevant that we discuss the important tax audit issues. While my presentation would cover most of the clauses and the related details which a tax auditor has to disclose, but what we would more emphasize upon would be the practical challenges or the practical aspects of a particular clause which every tax auditor has to keep in mind while conducting the tax audit. So these are the contents to be covered. We'll just go by one and take you through. So for conducting a tax audit, these are the prima facie reference material. We have seen that many of our colleagues and members, they somewhere whenever they have a doubt, they while we have WhatsApp groups, we have our colleagues to to go and discuss with them. But these are the basic reference material which any of the tax auditor, whenever he's conducting a tax audit, he has to go through. One is our Bible, which is the Income Tax Act. Then you have the relevant rule. So why I say this relevant sections and rules has to be referred upon is whenever you read through a section or whenever you read through a rule, the plain reading of any act or the rule gives you a broader, a reinstated perspective of the matter, and sometimes it is just the bare reading of the act or the rule which will uh, have a clear idea. You will have a clear idea of your doubt, and that will give you a better approach of dealing with things. Then we have our ICI guidance notes. We have a guidance note which was issued in 2014, which is very much applicable still. And it is a great document to refer upon. It highlights and it encompasses all of the details, minute details of each and every clause, right from the practical aspect, from a documentation perspective, what are the key challenges which the auditor may face. Everything is in detail covered in the guidance note. We had an implementation guide when there was introduction of new clauses. So there was an implementation guide which was issued in 2018, and that is all this along with guidance note are a very good reference material for having any doubt or any provision clarified whenever you have a doubt in a tax audit report while conducting a tax audit. Then not many of the chartered accountants know that there is a checklist which is issued by ICAI, which is very much available on the portal. And that checklist itself, you can it's a clause by clause checklist given by the institute, wherein it ensures and the tax auditor who is conducting the tax audit would not miss upon any of the detail, be it from a standards perspective, be it from a documentation perspective, and this will also act as a great reference point for any future references, wherein say suppose you do a tax audit for a particular client for say 5 years, and the checklist which is maintained in the first year will serve as a reference point for you to take and undertake a comprehensive audit in the forthcoming years. Then we have certain circulars which are issued by CBDT. These are prima facie for the ICDS which has come into picture, which was still a recent, I would say, a recent amendment, because not many of the chartered accountants are and even the tax authorities are going through these ICDS adjustments and are reporting. So these circulars which are there for applicability of ICDS have to be surely looked upon while conducting a tax audit. So apart from that, this Income Tax Act, Income Tax Rules, Guidance Note, and the CBDT circulars, we would have various jurisdictional High Court and Supreme Court precedents which a taxpayer may want to follow. Before proceeding into the specific clauses, a clause by clause analysis and the practical issues which a tax auditor may come across, the golden rule which remains is whenever you are in doubt, you have to disclose. Whenever you have something which is dicey, something which is unclear, you have to disclose that particular matter, and you have to make sure that each and every clause, when I say each and every clause, right from the name of the entity to any greater level of details which may be in relation to any transaction, that has to be documented, and each and every clause has to be supported with some supporting document. Whenever you have any Supreme Court or High Court judgment, or if a tax auditor wants to take a different stand from a taxpayer, if suppose there is a disallowance which you are going to disclose and the taxpayer says that it should not be disclosed. So in that case, if you are abiding by what the taxpayer says, you may document the fact that the taxpayer is relying on so and so jurisdictional precedent, and that is the reason by which this particular disallowance is not coming there. So these are the extended due dates which all of us must be knowing, that we have time till 15th of February to file a tax audit, and as well as Mithilesh was saying, 3CEB report, and filing of ITR for the companies and to the taxpayers for whom tax audit is applicable is 15th March. We also have the one more important part which everybody has to take note is that the revision time is till 31st March only. So you would have only 15 days of additional time to go through your original tax return or original tax audit filing, wherein if you want to revise a part of it, the additional time which will be available will be just 15 days. So this slide summarizes the applicability of the tax audit report. So as most of us must be knowing that the tax audit threshold is 1 crore, while there is an increased threshold which is available for most of the taxpayers, that is 10 crores. And when would you recon to this, or when would you apply this 10 crore limit is when the cash receipts as well as the cash payments, if they are not exceeding 5% of the total cash receipts and the total cash payments. So here you may look into that the word uses and. So the condition has to be checked for receipts as well as the payments. If the turnover is exceeding 10 crores, tax audit is always applicable. But if the turnover is less than 10 crores and your cash receipts and cash payments are less than 5%, then the tax audit may not be applicable. This is subject to this particular section 4484. We will just discuss that in the forthcoming slides. But otherwise, if the turnover is less than 10 crores and you have your cash receipts and cash payments less than 5%, then the tax audit will not be applicable. However, to clarify, the tax audit limit is still 1 crore. And for 44 AD cases, which is applicable to individual HUF and firms, you would, so if it's a company, the threshold will be 1 crore, and you will check for the threshold of 1 crore. If it is exceeding, it's applicable, and if it's not exceeding, it's not applicable. So for individual HUF and firms, you have an option to opt for the presumptive tax under 44 AD and 44 AE. So if it is 44 AD business case, then the turnover, if it is exceeding 2 crores and the cash receipts and cash payments are exceeding 5%, then the tax audit is applicable. And if the turnover is less than 2 crores, then you have to see if the tax auditor, if the taxpayer is declaring a profit of 6% or 8%. 6% is for the bank related transaction and 8% if the transactions are not undertaken by a bank. So this is a short summary of how the tax audit will be applicable. Now we have just have taken some examples to understand how and when a tax audit is applicable. So say suppose the turnover is 11 crores and your profits are more or less, since it is exceeding 10 crores, the tax audit will be applicable. Now here in the second situation, you see that the turnover is not exceeding 10 crores and the cash receipts and cash payments are not even exceeding the 5% threshold which is given under the Act. So in that scenario, the tax audit is not applicable. In the third situation, if you see, the turnover is still 9 crores, but the cash receipts have exceeded the 5% limit. Therefore, the tax audit will be applicable. In the fourth scenario, it's a company and it is 1.5 crore. So ideally, if it is exceeding 1 crore for a company and the cash receipts and cash payments are exceeding 5%, the tax audit will be applicable. Similar is the case for an individual HUF firm, but they will have a 44 AD choice. So if you are declaring profits which are more than 6% and 8%, then the tax audit will not be applicable. So I hope this particular table will be helpful for adjudging whether a tax audit is applicable or not. Now I was just discussing that there is a clause called 4484 clause 4, wherein the rule under 44 AD is that if you opt for a presumptive taxation, that has to be followed for 5 years. That has to be followed, and if it is not followed in the forthcoming year, then you cannot opt for 44 AD for the coming 5 years. So say suppose the assessee has opted for section 44 AD in the last 5 years, but he is not opting for it in the current year, then even if your turnover is up to 1 crore and your income is exceeding the maximum chargeable limit, which is 2,50,000, even in that scenario, audit will be applicable. So the catch is the turnover is less than 1 crore. You opted for 44 AD in the last year, but you are not opting for 44 AD now, and your turnover is less than 1 crore, and your income is exceeding the maximum chargeable exemption limit, basic exemption limit of 2,50,000, then even in that scenario, the tax audit is applicable. So this is something which all of us must be taking a precaution. And if that is, while this scenario, you may say that the turnover limit is not exceeding 1 crore, but that is how the provisions are worded and that is how it should be applicable. And if the turnover is more than 2 crores but up to 10 crores, then it will not be applicable if you are having the cash receipts and cash payments which are less than 5%. So this is how it has been summarized here. The second scenario is the assessee has not opted for 44 AD, then you would directly see the 10 crore limit. In that case, you don't have to see the 1 crore, 2 crore and all these limits, because the assessee was not opting for 44 AD in the previous years. So as we all know that 44 AB applicability is on the turnover criteria and the gross receipts criteria. So how and what all payments or what all transaction, what are the nature of various transaction which needs to be included. So this we have a great level of detail which is available in the tax audit, not only in the case of business, but in case of multiple business models. The tax guidance note perfectly summarizes how and in what scenarios what should be included in turnover and what should not be included in the gross receipts. So normally, if you see the 5.10 5.10 of guidance note, it states what all is to be included in sales, turnover and gross receipts. So these are normally must be construed in the commercial terms, since these are not that defined under the Income Tax Act. So sales tax, GST, excise duty, these are to be included only if the assessee follows an inclusive approach. And most of us, as far as on date today is concerned, most of the people follow a mercantile accounting method, and GST and sales tax is a balance sheet item. So it's whatever is payable and receivable is accounted through a balance sheet, and it doesn't route through your P&L. So so that is where sales tax and GST are normally not included. These are some of the inclusions and exclusions. This is just a replica of what is there in guidance note. So if there is anything, anywhere a doubt when conducting a tax audit, or there are borderline scenarios wherein you have to decide upon the applicability of tax audit, whether 1 crore or 10 crores, or for that matter 2 crores, if it is breaching or not. These are the some of the areas which are summarized in the tax audit, which will help you to come to a conclusion whether a tax audit is applicable to a particular taxpayer or not. So in case of share brokers, and this is specifically for people who are conducting business, the normal day-to-day business, and these are for special category businesses where share broker, if he is buying and selling on behalf of its client, surely since it's buying on behalf of its client, that will not form part of the turnover, and it is only the brokerage income and brokerage related expenses which should form part of the turnover. Similarly, for speculative transactions, this is since the beginning of pandemic, many of the people and many of the chartered accountants, if I have to tell, they are carrying out transactions in shares, futures and options, and many of the securities. So this is something which is very relevant there. So speculative transaction, if it is, say, suppose you enter into a intraday transaction and you carry out an intraday transaction, so it is just the aggregate of positive and negative difference which you have to take, and not the actual amount of share price or the security price which is appearing on the portal. It is just the positive and negative differences which you take for speculative transactions. For derivatives, futures and options, it is the total of, again, favorable and unfavorable differences, premium which you have received or paid on, whenever you buy or sell options, you have to pay a premium. So that premium is added, favorable and unfavorable differences are added, and this is it. You don't actually add the security price, which is which, say, suppose Reliance future and options or any other future and option, you will not add the security price, and it will be just a summation of favorable and unfavorable differences and the premium which is there. So in agency business, it is, if it's a principle, you have to see the age-old principle of significant risk and reward being transferred. If the risk and rewards lies with the principal and the agent just deals with the goods, then it is only the commission which is to be considered for the purpose of turnover. However, if the agent is also taking the risk and rewards while conducting the sale, then it shall form the part of sales and turnover. So that is what that's a bird eye view of the turnover criteria or the gross receipts criteria which is given. And if there are any further queries or anything, yes, you can always refer to the tax guidance note which is there. And if there are any other doubts, you can always reach out to us. So this is specifically for the presumptive sections 44AD, 44ADA, and 44AE. So for these sections, whenever specifically for 44ADA and 44AE, if your assessee is claiming profits which are lower than the presumptive rate which is given there, say suppose 50% for professional income, and your income is exceeding the maximum amount which is chargeable to tax, then you have to maintain not only the books, you have to also get a tax audit done. So how this is the scope of the tax audit, what a tax auditor has to cover, or what prima facie matters he has to cover in a tax audit. So whenever a scoping of a tax audit is done, it should always stick to the 3CD and 3CA requirements, and that is how the scoping needs to be done. Because tax audit report, it's a document which assists not only the taxpayer but also the tax authorities to freeze upon the allowances or disallowances what a taxpayer submits in his tax return. So your scoping and everything needs to be done in accordance with the form 3CA, 3CD and the other guidance which is available. So there are two forms which always go along with a tax audit report. The forms if you go by the name, they are 3CA and 3CB. So many of the people, they get confused, like when is a 3CA applicable and when is a 3CB applicable. So 3CA is applicable whenever there is a tax, there is an audit which is already done under another law, and you have to just certify the tax audit requirements in form 3CD. So in that case, you don't do a complete audit of the entity because already an audit has been done under some other statute and a report is given by the statutory auditor. But if that audit is not done or it's not mandated under any other law, then the tax auditor has to certify not only the tax audit matters, but he has to conduct a full audit, a full scope audit. And that is where Form 3CB is to 3CB has to be filled. So that is the difference. 3CA, where there is any other audit done under any other law, and you are just conforming to the tax audit requirements. And if there is no audit mandated under any other law, then the tax audit has to be conducted in Form 3CB followed by 3CD. So this is just a summary of what is how these two forms are different. These are the major components. So if you see 3CA and 3CB, the major component will be in 3CB, you have to specifically give a declaration that you have obtained all the information and explanation which is necessary for you to conduct the audit, because there is no other audit which was done. So it's a more so a responsibility for you to conduct the audit, a complete audit, not only a tax audit, but also you have to determine whether the underlying numbers on everything which is provided are fair or not. So Form 3CD, it's divided into two parts, Part A and Part B. Part A is comprises of the general details and the general details of the business of the SSE. And Part B is where section-wise reporting is done for all the clauses. So these are the Part A clauses: name of the SSE, address of the SSE, PAN, registration under indirect tax laws, status, previous year ended, assessment year, and clause under 44AB under which it's audited. So while if you look at these clauses, clauses might look that these are like very basic details and which would be very readily available. There would be a catch here if there is a sometimes we miss that the entity has changed its name and it has not updated its PAN. There may be a change in the registered office. There may be a change in the form of the entity due to some conversion from a sole proprietorship to a firm. And sometimes there may be multiple registration under various laws, which you have to, take a note from the SSE, and then you have to present the matter. So while these may appear as very basic, but each and every clause, as I told already, has to be substantiated with a proper documentation. And it's better that you have a clear case or a clear document for furnishing each detail in the clause. So name, as I discussed, there may be a change in name, there may be a change in address. PAN usually doesn't change. Registration, when you come under registration, whether we as a tax auditor, you are liable to take to see whether it's applicable or not, or whether all indirect tax registration have been done or not. So is it a tax auditor's responsibility? So in that case, the guidance note says that you don't have to look into the applicability of all the indirect tax laws, and you can just obtain a representation from the management saying what all is applicable and what all registrations do they have. So from a tax audit standpoint, that is something which is more or less would do good for this particular clause. Next would be previous year ended. This will be very specifically end on for certain entities, says if you are discontinuing the business or some operations have been shelved or have been stopped. In that scenario, the previous year may end on a separate date rather than 31st March. So that is where there may be a change here. So the most and foremost important clause is 8 and 8A, where most of the practicing colleagues might make a mistake here, because this is something which I have practically learned after doing a mistake. So this during my early days, wherein this was very casually selected as something as A or B or whatever some of the other clause, but these clauses has to be selected. There are 5 subclauses under 44AB. So if you are exceeding which limit or presumptive tax or the other 44AE or ADA, which case you are falling under, that particular clause has to be selected and has to be reported. So again, there is an addition on 8A, wherein you have to, where the tax auditor has to specify if the taxpayer is opting for any of the beneficial regimes which are available these days. So which can be 115, BAA, BAB, and BA and BAC. So all these beneficial regimes, if a taxpayer is opting, the tax auditor has to indicate here. The another mistake which many of the taxpayers are committing, and which as a tax auditor, which you may help the assessee by stating that the form which goes along for opting any of these beneficial scheme has to be filed before filing the tax return. So we have come across certain practical cases where the assessee, while he opted for a 22% rate or maybe the 15% rate, but forgot to fill the form 10IB, 10IC, 10ID and all. So you have to make sure that the tax payer files this particular form 10IC or 10IE, whichever is applicable to the assessee according to the beneficial regime which is opting. So that has to be filed before filing the tax return. And it's better that if it's filed before the tax audit, that is because you have to give the option here. So when you are indicating that thing here, that has to be opted in the form by the taxpayer also. These are the other clauses. These clauses are just listed. So I'll just go through the list, and then we will just go through some key issues for most important clauses. 9A, 9B is for AOP and partnership firms, where if there is any change in the profit sharing ratio or change in the partners, or if there is any change in any of the constitution related things, that has to be substantiated with the amendment in partnership deed, or for if it's an AOP, it has to be documented by any of the resolution or anything which is passed by the entity. 10A, you have to mention the nature of business. The only thing which you have to be careful is all the businesses which you are tax auditing has to be mentioned here. And if there is any nature which is added or which is changed, which may be due to the mergers or demergers, wherein you add upon another entity which is doing some another sort of business, then that has to be mentioned here. 11 is a clause which is specifically for books of accounts maintenance. So 44AA is the section wherein it has been, certain books have been prescribed for only the professionals, that too listed professions. There are only a few listed professions which are available there, for which this 44AA is applicable. Apart from that, there are no books as such which are prescribed for other business or profession related taxpayers who are conducting their business. It is only for certain specified professionals which there is a prescribed books which is available. So apart from that, what you have to ensure as a tax auditor is that for a business profession, all the relevant books which may comprise the general ledger and all related credit notes, debit notes, or some of the board meetings related which are impacting the tax issues. So all those things are relevant accounts, documents, maybe the GST returns, reconciliations, and all those things are thoroughly checked, and these are mentioned here. And while 11A is for prescribed, 11B is for maintained, 11C is for examined. So this is the difference which you have to be very specific and take a note of. Prescribed is only for professionals. So if it's not prescribed, you can just give the certain details which are being maintained in 11B. And then out of 11B, what you have actually examined has to be mentioned in 11C. You have to also mention where the books of accounts are maintained. So as per Companies Act, you can actually maintain books of account at a place other than registered office. You have to pass on the relevant resolution, and you can even in MCA, whenever you see the master data, there will be two addresses which will be available, one where the books are maintained and one where the registered office is. So if an entity is opting to maintain and books at any other address apart from the head office, then that has to be mentioned here, and that can be checked with MCA. That is what you have to do. That was 11. And for clause 12, you have to, it's just the presumptive income. If the profit and loss account, if it includes any of the presumptive income, 44AD, 44AE, or any other presumptive income, so that has to be mentioned here. The tax auditor should not actually check whether that 8% or in 44A that 7,500 per vehicle or 1,000 per ton, if that is being done or not. That is not something which the tax auditor has to check. He has to just give the figure which is included in the profit and loss account, and which is presumptive in nature. So that itself would be a sufficient compliance from a tax audit perspective. Clause 13, from a method of accounting employed, as most of the entities these days follow mercantile basis of accounting, and this cash accounting will be applicable only for certain professionals or certain offices who actually maintain their books in the form of cash concept of accounting. Otherwise, more or less, the method of accounting will be mercantile, and if there is any change for any particular assessee, that has to be mentioned here, and the impact arising from that particular change has to be mentioned here. And in clause 13, there is another thing which is very important, which is ICDS. ICDS, when it was launched, it was the effects of ICDS were not linked properly in ITR, wherein you had some people were disclosing the change in even the difference in depreciation was being disclosed, and some tax auditors were actually not opting to disclose the difference in depreciation and the other differences which are arising. These specifically ICDS has to be taken into account only for specifically, if I have to say, because these ICDS, they have a parallel, or they are somewhat similar to the accounting standards what we already have, barring few changes here and there. So most of the things there may arise no adjustment as such, but for construction contracts, or maybe from a contingent liability perspective, or sometimes the depreciation, say suppose it is goodwill which is included, and then you are disclosing a depreciation. So all those things, a tax auditor has to take a conscious call whether something has to be disclosed in this particular adjustments for ICDS or not. So 14 is for method of valuation of closing stock. This the accounting standards which are previously there were two accounting standards. They are still there. Two accounting standards under section 145A. So as per that particular accounting standards, you have to, the method which has to be followed for valuing the inventory is the inclusive method. That means all the taxes and all the sales tax, GST, and all the indirect taxes has to be added up to the opening stock, purchases, sales, as well as the closing stock for having it valued under Income Tax Act. So since all of us or all the taxpayers would mostly follow the exclusive method, the change in the change arising because of inclusive method needs to be disclosed, here in clause 14. 15, this is for capital assets which are converted into stock in trade. So this is very particular for entities like who are in actually doing the real estate business, wherein sometimes the certain amount of inventory is kept as a capital asset for the purpose of the entity, which may be used as their office or some other capital asset for the purpose of business. But it is sooner or later converted into stock in trade. So this, for having a disclosure, one has to keep in mind all the relevant provisions like 247, or what is a capital asset, when there is a transfer, what are the transfers which are exempt from capital gain, and all those relevant provisions have to be kept in mind. So whenever a capital asset is converted into stock in trade, when the stock in trade is sold, at that time the taxation comes for the capital gains and the business income. So that is how, from a tax audit standpoint, you are required to just concentrate on these 4 aspects, wherein you have to give a description of the capital asset which is being converted, when was it acquired, and cost of acquisition. This is cost which is recorded in the books of accounts, so that cost has to be disclosed, and amount at which the asset is converted into stock in trade. Normally the FMV as on the date of conversion minus the cost of acquisition is charged as capital gain, and from FMV to the stock in trade value which is then sold is taxed under PGBP. 16th is a clause where this actually requires a professional diligence needs to be taken on the part of the tax auditor, because these are the items which are not apparently appearing on the face of the balance sheet or on the face of the P&L, and a tax auditor has to dig down and go into the deeper details to understand if there are any items which were requiring a credit to the profit and loss account, or may not be requiring a credit to the profit loss account, but as of now are not credited to it. So these disclosures have to be given only in a scenario where there is a requirement to give a disclosure. The reason why I say so is, as most of us have experienced that there are adjustments being done once a ITR is processed, and when an ITR is processed by the CPC does a reconciliation between the ITR and 3CD. So any amount or anything which is disclosed in tax audit, if it doesn't find a place in your ITR under a relevant clause or the relevant part of the schedule of the ITR, adjustment is done automatically by CPC. While CPC may give you an option, the taxpayer may be given an option that this particular adjustment you want to disagree, you may disagree. But the fact remains that even in a scenario you disagree with the adjustment, just because there was a difference between ITR and 3CD, the adjustment would be done, and this will be a litigation issue wherein the taxpayer has to then file a CIT appeal, and if a scrutiny is already in place, then has to request the AO. And now since there is no manual proceedings which are happening, and it is all the NFAC which you have to deal with, to practically explain the adjustment which has happened because there was a mismatch in ITR and 3CD would be really difficult and challenging to get that adjustment removed. So these items, section 28 and section 28 enlist certain items of income which are in the nature of PGBP. And if those items are not particularly disclosed or are forming a part of, say, your balance sheet and not your P&L, then they have to be reported here. So 16A are such items. 16B are the refunds, drawbacks, custom related scheme related incentives which a taxpayer gets, which are normally a balance sheet item and which are admitted as due. The most important word is admitted as due. So this is nothing, there will be a no disclosure here if only a taxpayer is making suppose a taxpayer is making a claim of a duty drawback, then it should not be disclosed here. Only when in a case where that duty drawback has been admitted or has been acknowledged by the authorities concerned, maybe the GST authorities or the relevant authorities, when they admit that particular thing, that has to be disclosed in clause 16b. 16C, escalation claims. Escalation claims are normally arising where out of the contractual obligations, you enter into a contract with the party and there is an escalation clause or escalation claim which is documented there, and that particular conditions, when they are invoked, when those conditions actually exist in reality, and your escalation claim is accepted by the other party, only in that scenario there are fair number of case laws available on escalation claims. So when an escalation claim has to be recorded as income or not, so even a tax auditor has to disclose an escalation claim only if it is accepted. Any other item of income which sometimes certain incentives or may be given as certain incentives may be given, and that may be recorded as a liability item or maybe directly reduced from the liability. So in that case, a tax auditor has to disclose. Capital receipts, this is in general, if there is any capital receipts, and since most of the capital receipts will not be routed through P&L. So when I say capital receipts, not all capital receipts, say suppose share capital or loans, not all those capital receipts has to be disclosed. Only those capital receipts which partake a nature or partake or have a parlance with income, which can be an income and which were not credited, though being capital, maybe a grant for that matter. You have received a grant from a government and it's not credited to P&L. It's just appearing as a balance sheet item. Then in that scenario, you have to disclose it in the capital receipt. 17th is for land building. This is specifically for 50CA and 45CA. So 43CA, sorry. So you have to disclose if some land or building, if specifically for real estate taxpayers, where if you have transferred any asset which was less than the stamp duty value which is adopted by the authorities, that has to be reported here. The only catch here is that one has to disclose. There was an amendment. I'll just discuss that thing in our forthcoming slides. 18 is for depreciation. There is one amendment related to that. I'll just discuss in the forthcoming slides. Uh, 19, it's all for incentive related things which have to be disclosed. While this is discussed in detail, but the only thing which a tax auditor has to check is that the specific conditions which are there given in the section, and there may be tax audit reports. Other than the tax audit report, there are other forms and other formalities which an entity has to do when they opt for these particular specific sections. So all those particular specific formalities are being undertaken, and at least the basic formative conditions which are given in the section are being complied. So that part has to be taken care by the tax auditor. 20 is again for this is something where an employee has to be paid a bonus commission, but this is not for the general bonus commission which is given to employees. This is specifically for that bonus or commission which otherwise you would have given it as a profit or dividend. Say suppose somebody who is a director or a shareholder is also an employee of the company, and instead of giving him a bonus, or he is actually not eligible for a bonus or commission, but you give him a bonus or commission, and instead of giving a dividend. So dividend, since it has a separate taxability and separate tax implications, people to take a benefit, and dividend being an below the line item, so it comes after profit after tax. So bonus or commission, if it is given to such employees and such personnel, then it has to be disclosed here. 20B is contribution made to all employee funds, which is EPF, ESI, and other employee welfare funds. So one thing which we all must be knowing, that there is an amendment by last Finance Act, wherein if there is even a single day delay in making a employee contribution, employer contribution is always allowed, even if it is delayed, but employee contribution, if it is delayed even by a day, then it is a straightforward disallowance. And this is the most common adjustment which all the taxpayers may found in their while processing by CPC. Is all for 21 is a specific clause for all disallowances, all specific disallowances, which are there in section 40, 40A and other related sections. So this is there in the ensuing slides. 22, this is for MSME interest. Many of the, because of lockdown and because of all related the current conditions which are prevailing, there are many entities which are registered as MSME, and MSME, whenever there is an invoice, that has to be paid within time, and if it is not paid, there is a statutory interest which the even MSME can't help, and that has to be reported. And because if you pay any interest to MSME because of the statute which is there, that is inadmissible. It's kind of a discouragement which the tax authorities give for MSME payments if it is not done within time. 23 is for related parties. This is, while it is discussed in detail in the ensuing slides. '24th and 25th. These are 24th is specifically for special incentive sections, which most of them are under sunset now. Very popular were 32AC and 32AD, now being in sunset. So if there is any amount, so all these sections, 32AC, 32AD, all these sections, they have a certain conditions, and if there is any breach of those conditions, the earlier deduction which was given to the taxpayer is disallowed and it is deemed income. So these particular there is sometimes a time limit of 5 years and sometimes 8 years. So a taxpayer has to ensure that 32AC and 32AD conditions are being complied, and it's the provisions which are there for reversal of the deduction or deemed income, considering them as deemed income, are not invoked or not are done during the year. 25th is for section 41. So section 41 in specific has 5 different clauses. The most common being remission and cessation of liability. So basically, if you have claimed something which as a deduction earlier, and now there is a reversal, or you don't have to pay that liability anymore, then that's a remission and cessation of liability, and that particular has to be, that particular amount which is reversed has to be disclosed here. Apart from that, there are other things also which are like if you have incurred for scientific research and you have sold that asset which was used for scientific research, if it was not, you have contemplated it to be used as for scientific research, but you end up not being using it for that particular purpose, then that particular deduction which you have taken earlier has to be reversed. So all those related specific 41 related section related has to be discussed in clause 25. The principle remains the same, that any amount which was allowed earlier and now there is a reversal. 26 is the most common clause which is filled by most of the entities. This is 43B has got certain specific payments like tax, duties, interest to banks, payment to Indian Railways, and other employee related leave encashment, bonus, commission, and all those employee related, where the tax authorities would give the benefit only when they are actually paid. So since most of the assessees would be following a mercantile system of accounting, and debits would be there in the P&L, there may be a chance that payment is not being made. So all those things which are paid within the due date of tax return filing are taken as allowance, and if they are not paid within that date, that has to be disallowed. While this is discussed in detail, the another catch here is that you have to ensure that the carried forward amounts are properly disclosed, and carried forward amounts are allowed till 31st March of the financial year, and something which is incurred during this particular financial year and not paid, that is allowed till return filing date. So something which is carried forward from earlier years, that may not be allowed if it is paid after 31st March. So these SENVAT related details you have to give, prior period items. These are specifically disclosed in financials most of the times, but still, if there are any prior period items which you come across while doing the tax audit, that has to be disclosed. 28 is discussed in detail. These 28, 29, 29A are discussed in detail. 30 are hundi transactions, which are very specific to certain assessees. 30A and 30B are transfer pricing related. These are discussed in detail. I'll just go through that also. Then you have 269 SS, T and ST. These are there in detail in the ensuing slides. Details of loss of a speculation business. If there are any speculation business which this is specifically required, since there is a limit to which the speculation loss can be carried forward. It is regularly it is 8 years, but for speculation loss it is 4 years. So that is the reason it requires a special mention. Specified business, if you have anything, that has to be like 35AD business, if you have it, that has to be specifically reported here, details of loss. Then you have chapter 6A deductions, all 10A, 10AA. One common question which almost normally all the tax auditors have for individuals who are also having a business income, whether ATC, ATD related deductions have to be disclosed in clause 33. The answer is no, because if it is the business which you are doing a tax audit, and since most of the LIC and Mediclaim will be related to their personal expenses and not being a business expenses, that would not form part of the audit, and that may not be disclosed in this particular clause. 34, it is discussed in detail, and it pertains to the TDS. 35 is for giving quantitative details. When giving quantitative details, mostly if it's a large concern, it's a very big concern, then it may not be possible to give details of all and every items under this particular clause. So guidance note requires you to disclose only the principal items. And when I say principal items, it is like 10%. something which is exceeding 10% of raw material, finished goods, and work in progress. So that can be something which is exceeding 10% of all that aggregate may be disclosed here. Only the principal items may be disclosed. Details of deemed dividend 222E. This in specifically you have to check the related party schedules, wherein you have to check whether if there is any amount which was given to somebody who has a substantial interest as per 222E. So if somebody has a substantial interest, that has to be disclosed in deemed dividend. 37 to 39 are details of the tax, cost, excise, and service tax audits. Service tax audits, they might not be getting done now, only for previous period wherein it was applicable. There may be a possibility, but if there are any audits under cost, excise, or service tax, and if there are any disqualification or if there are any specific observation, that has to be noted down in 37 to 39. 40 is accounting ratios. While it is very specific for large manufacturing concerns, wherein this particular accounting ratios, that may require a separate Excel to be maintained, and whatever approach you follow, since there is not much of guidance available on this, so whatever approach you follow for calculating the GP, NP, and these particular ratios, it is suggested that you maintain an Excel, and that is fairly replicated in the coming years. 41 is for demands and refunds. So demands and refunds under tax laws other than income tax and wealth tax. So you have to disclose income tax and wealth tax, since the department will always have a record of it available with them. It is only specifically required for other laws, wherein any penalty orders or any assessment orders or any refund orders, if they have been passed during the previous year, then they have to be disclosed in 41. 42 is specifically for specified financial transaction, as most of us must be knowing that by 31st May we make this filing, wherein the new AIS and TIS is being populated, wherein all the details of transactions, whether it is relating to share transactions or bank transactions or share purchase, sale transaction of unlisted entities, even they report these particular matters. So all these, if those particular transactions were there in the entity or done by the taxpayer, then he has to file Form 61, 61A and 61B. These are applicable to different class of taxpayers, which is there in Section 285BA. So all those filings, if they were done or not done, have to be reported here. 43 is the CBCR report, which Mithilesh was discussing, and if there is any applicability, and that report has to be filed. Not only it has to be filed, it has to be reported that it's been filed in as a part of your tax audit. 44 is something that might require a good level of detail calculation and Excels being maintained by all the taxpayers, but it's not applicable as of now. It is put under abeyance till 31st of March. So that's not applicable. So while I have discussed most of the issues, even under the important clauses, I would just run through these slides, and if there are any specific issues which needs a consideration, I'll just go through them. So clause 12, you have to mention the presumptive income. The only challenge which may arise is, say, suppose the assessee has two business. One is under presumptive, one is not presumptive business, and he is maintaining a single books of account. So in that scenario, the presumptive income or the presumptive non-presumptive income would require a segregation, and this segregation ideally has to be done on a logical basis. Maybe, say, suppose if some expense is relating to the employees, so it can be done on the basis of the count or the payroll, the trends in the payroll. So that is how you can segregate the presumptive income from non-presumptive income. But if the assessee or the taxpayer is not at all maintaining any separate records, and even the tax auditor is not in a position to comment upon what is presumptive, what expenses relating to presumptive, what expenses not relating to presumptive, then he has to specifically give a qualification. So deduction, all deduction for 40A, 43B, brought forward losses, everything has to be segregated for presumptive and non-presumptive. And for brought forward losses, one has to see a presumptive, while there may be a presumptive income, and you may have a loss and for the non-presumptive business. So can you set off, or the brought forward loss which is there for non-presumptive income, can it be set off against the presumptive income? The answer is yes, because the set off is not governed by 30 to 38, and only unabsorbed depreciation is something which can't be, or which cannot be set off against between presumptive and non-presumptive businesses. So these are we have already discussed amounts not credited to P&L. So you have to, the auditor has to take a specific confirmation or exercise all his diligence before reporting anything under clause 16. Admitted by concerned authorities. We discussed this, that a certain claim, if you have made like duty drawbacks and everything, that has to be admitted by the concerned authorities. Escalation claims. So there is a famous ruling in Hindustan Housing and Land Development. It's basically the same principle, that escalation claim has to be accepted. It is not that if just because there is an escalation clause in the agreement, there should be a reporting here in this particular clause. Any other income from other sources also, yes, you have to disclose. Capital receipts, as we discussed, not all capital receipts are to be disclosed. It is only amount of professional judgment which you have to carry out, that something which is in the nature of income and still a capital receipt, that has to be disclosed. Land or building, there was one amendment last year that you had a increased tolerance band. And so if that increased tolerance band of 10%, whenever you make a sale of particular land, building, or any of the immobile property, and the difference between the sale consideration and the stamp duty value which is adopted by the authorities, that has to be within the range of 10% or 20, within a range of 10%. So this was increased to 20%, and this was specifically only for this period, 12th of November 2020 to 30th June. And this is applicable not for all land, buildings and everything, but it is only for residential units. That too, the value should be up to 2 crores. So this has to be specifically reported by the tax auditor in clause 17. Depreciation, while we do a normal depreciation calculation for most of the entities, but specifically for software industry, some taxpayer who are dealing with IPs, licenses or softwares, there may be a chance that there was another intangible called goodwill, and that particular depreciation is already removed. That you cannot, goodwill is no more a depreciable asset, and you cannot claim a depreciation for goodwill. And say suppose this goodwill was carried forward from earlier years, as on 1st April 2020, if goodwill was forming part of your WDV of intangibles, then there is a specific calculation which you have to do as per Rule 8AC, which as per that particular rule, if there is an excess WDV, then that has to be offered to as short-term capital gain. So there is a specific, there are 3 scenarios which may arise, and there are many examples which are available across domains. So that particular, wherever there is a goodwill which is there in the WDV, you have to ensure that Rule 8 CA is followed and particular adjustment is done to the depreciation schedule. There may be situations where assets which are very specific to a particular business, that may require you to take an understanding from a technical person, whether it is put to use or the valuation or maybe another things, which as a tax auditor, you may not, take a judgment as to whether that is a particular depreciable asset or not, because that whether it is being put to use, whether the valuation is correct or not. So specific chartered engineers or any other technical person or expert help you may require, and that has to be taken. So Rule 115 BAC and all, they require certain adjustments to the WDV. If you're opting for these specific regimes, 115 BAA, say suppose this is the first year where you are opting for 115 BAA and you had certain losses which were relating to some specified business. So that is no more allowed as a carried forward loss. So in that scenario, where the carried forward loss includes something which was relating to special business, a specified business, then that cannot be carried forward. So that adjustment has to be done in the depreciation schedule. 32AC, 35E, we have discussed. You have to specifically see the deemed income. For these things, 32AC and 35 to 35E, there may be a report which is required from the other auditor. Sometimes it is the tax auditor who gives the report, but if any other auditor gives you a report for a specific unit, say suppose it's located somewhere in Himachal, and that particular unit is being the particular, say for a claim in section 35 for scientific research and all, or in-house R&D. So that particular report is given by other other auditor. Then you have to what extent we have to rely on, or what should be your stand, and everything. All this are dealt in our standard of auditing, where reliance on how and when we can place a reliance on other auditors and experts. So that has to be followed. So this is the same thing. Whether payments qualifying for deduction under 80D, etc., might not have been paid out of business income, but personally should same be disclosed. So whenever if there is a doubt, and you have to disclose that. That's the golden rule. Clause 21. This is specifically for the normal disallowances which arises as per PGBP for non-deduction of TDS, for making cash payments in excess of 10,000 rupees, or making a provision, making a contribution to unapproved gratuity fund. Now, this unapproved gratuity fund, specifically, the tax auditor has to take care that the disallowance would arise even if there is a policy with LIC. The allowance is available only if it is approved by the commissioner. So there is a difference. Many people confuse these two concepts, that approved gratuity fund and unapproved gratuity fund. Approved is simple. The answer is simple. Approved means it has to be approved by the commissioner. Even if you have a policy with LIC, it is still unapproved. That has to be that a specific approval has to be obtained from the commissioner. And if that is not the case, there is no approval, that is unapproved, and it has to be reported under 40A7 and not under 43B. 43B is for approved, 40A7 is for unapproved. So if it is unapproved, all the provision done will be disallowed, and you will take a allowance only at the time of making actual payment to the employee under 37. But if it is approved gratuity fund, the minute you make the contribution, you can take a allowance, even if it is paid after the 31st March, but before filing the return date. So So that is governed by 43B if it is approved by commissioner. So 14A and all contingent liability, I have to specifically tell that this contingent liability has to be disclosed only if it is debited. Now you may ask that if it is a contingent liability, how and why it would be debited to P&L account. So it is something which was contingent earlier, but now it is debited. So that specific detail you have to give. And in my practical experience, this is being taken as an adjustment by CPC. So professional care needs to be taken before making any disclosure under this particular clause. So these are the normal items which are there. One has to take care that this particular schedule will reflect to schedule OI in the ITR. So whatever amount you are, say suppose there are 2 penalties available here. So if you are disclosing something in this penalty and the tax auditor reports under this particular clause, both will be disallowed at the time of making at the time of processing of the return. So you have to take care that whatever is disclosed in ITR, the same column and the same particular wordings, if I have to tell you, have to be followed in both. These are for club membership fees and all, not very specific. This is for 40A, 40AI and 40AIA, which are non-deduction cases. For if you are making some payments and you have the SSE either has not deducted but not deposited, then you have to report in 40AI and 40AIA. What one has to take care is that whatever you report in 40AI and 40AIA should correspond to clause 34, which is a summary of the tax deducted. Many a times this clause 34 is filled basis the TDS returns, and disallowance, if there is any, it is reported in 40AIA, and these two doesn't talk to each other. And at the time of scrutiny, the tax officers normally ask that you have disclosed something which is disallowed, and in 34 there is no disallowance. So that has, these two clauses have to talk to each other. This is for the amendment which was recently made for PF. That is there. This we have already discussed. Gratuity disallowance in 40A7 versus 43B. 14A and related disallowance has always been a matter of litigation, and it is something which is never settled. So due care, and if any specific if there are any precedents which are followed by the taxpayer, that has to be that may be qualified or taken as an observation in your 3CA or 3CB. Payment to related parties, this has to, the related party definition as per Companies Act, as per Income Tax Act, and many other laws is different. So you have to take care that payment as per 40A2B is disclosed as per Income Tax Act. So whether capital nature are required reporting, anything, if it is a hit, ideally if it is a hit to the expenditure, it has to be disclosed. But something capital nature and you are going to claim a depreciation on it, then it may be disclosed here. So for sometimes these are very dicey matters, related party matters. So you may not have a proper trail or proper detail of the connection between two or more people. Then at that time you can always, put an observation in the 3CA, 3CB that this is disclosed as per something which is given by management, and why and how you are not able to disclose this particular matter. So gross, these are very general, something which we have already discussed. So whether you have to have a reconciliation between AS 18, Ind AS 24, and TP certificate also, because all these will have the related party transaction. (43B), we have already, these are the items which are to be disclosed in 43B, and a due reconciliation has to be done between last year's audit report and current year's P&L. So these are the check pointers, just what we have discussed. Like you check for the last year, you check with the DAR and ITR. If there is any mismatch, there is a straightforward adjustment which is done. SENVAT and prior period expenditure, that's something which you have to disclose. 56 to 7, 7A, 7B, 9 and 10. These are the income. These are specifically where any property is given to any of the taxpayer, and something in excess of 50,000, whether it is cash or other something which is not cash, any other property. The term property is defined under 56. So only for those properties which are defined under 56, that requires a reporting here. And what all amount has to be reported has to be given in this particular clauses. So points to be kept in mind. See, 5627B, it requires 11 UA valuation. No more chartered accountant can value this, and it is a report, something which is required from a merchant banker. And if it is something which is not there, there are fair amount of litigation for each of the transaction. If I have to, if we go into detail of these, but you have to ensure that these specific clauses are disclosed. So you have case laws for transactions for shares, whether rights or bonus issue. Rights is always given something below the par. So whether that should come as a disclosure under 56.210 or not. So you have Sudhir Menon's case. It's a very famous case law. And whether waiver of loan, whether it is 56.210 or not. So all these things are, there are case laws, but since these case laws are not given by Supreme Court or anyone, you have to take a conscious call depending upon the jurisdiction in which you are operating, and that has to be done. Secondary adjustments, as Mithilesh was discussing, if there is any primary adjustment made, say suppose there is a TP adjustment which is made by the AO and I accept it. I have applied for a APA, department has accepted my APA thing, and then I have applied for a map that is flown through, and there are adjustments because the tax authorities will give you ALP which has to be applied, that may require a adjustment to the transactions which are already done. And now if that, say suppose I had a revenue of 100, adjustment is and I had a TP margin of 12, and now the TP margin is increased to 18 by APA. Now there is 12 to 18, there is a 6 rupees of difference which has arisen. Whether that 6 will come back or not come back, that has to be particularly reported here. So there is specific rule 10CB. If that amount is not given back to the AE within the specified time, then there is, as per rule 10CB, you have to get an imputed interest also. So if there is a primary adjustment, there will be a requirement of secondary adjustment, and all those has to be reported here. That is specifically from a TP perspective. This is also something which is arising from a transfer pricing standpoint, that if you obtain a loan from a AE, your associated enterprise, and you are paying them interest, you can't pay them the amount which is in excess of the normal standard market rate, which is if it is exceeding the EBITDA by 30%, then that has to be carried forward, just like business loss, for a claim for in future years. So that if there is any 94B related, if you have obtained a loan from any PE, from a AE, and you are paying any interest, then you have to do this EBITDA calculations, and all the amount which is there, what is the EBITDA, how much amount is exceeding EBITDA, and what should be carried forward and what is brought forward has to be reported in this particular. 269 SS, ST, and T are always a matter of litigation, but these are very detailed clauses. Like SS is for security deposits and immovable properties. T is also for securities deposits and immovable properties. ST is for something other than these transactions. SS and T will have a 20,000 as the limit, and ST will have 2 lakh, and that is ST is a new section wherein if you are incurring any entering into a transaction in excess of 2 lakh from a person in a single day in respect of single transaction, or there are multiple transactions but they are relating to one event or one person or one occasion, then that has to be done through bank account, account pay, check draft, and or either through ECS, which are RTGS and NEFT. So these all will require a thorough reporting, and normally if there is any iota of doubt on any of the clauses, there are many case laws and many precedents which are available, which have to be carefully looked into and followed. Brought forward losses and unabsorbed depreciation. This is specifically for a company. If there is any change in shareholding, then that amount can no more be taken forward as per section 79. So whether there was a change in shareholding, or if there was an assessment which was done wherein your loss was reduced, or any of the brought forward depreciation is reduced, all these things, or if you are opted for 115 BAA, BAC, BAD, the new regimes, and which require adjustment to be done to the depreciation and all, then those things have to be taken care, and appropriate disclosure, the amount which is ideally available as brought forward loss and unabsorbed depreciation, has to be disclosed. And there were DTVSV, you must be knowing that there was a specific option given under DTVSV where I can either adjust my brought forward losses, or I may pay taxes and I may carry forward the business forward losses and unabsorbed depreciation as is. So because of DTVSV, if there was any adjustment to be made to the brought forward losses or unabsorbed depreciation, that has to be, these are like the key points which have to be kept in mind. Chapter 6 is chapter 3 we have discussed. 80JJAA, there is a form requirement which has to be filed at that particular form has to be filled, and any specific reporting that has to be done here. TDS, as I discussed, this has to be there. There are these key points which have to be kept in mind. You have to reconcile it with book. It should match with your ITR and clause 21. Lower deduction limits and certificates, they have to be specifically checked. If there is any lower rate other than the specified rate which is given in the section, if you are following that requires a separate disclosure in that subclause 6 and 7. So that has to be done. TDS on year-end provisions, if they are determinate provisions, that has to be done. So details of TDS returns. When you are giving TDS returns, there is a tick box required that all the transactions are properly included. So you have to be sure that all the TDS compliances are done for all the transactions which are there in P&L. And if there is any interest liability under for TDS or TCS for that matter, that has to be reported. Clause 41 we have discussed. And ICDS, as I told you, these are disclosures which have come across, and these have to be specifically given if there is a specific adjustment required. Otherwise, there are disclosure requirements given under each of the ICDS that has to be followed. There is a disclosure requirement. Some ICDS don't have any disclosure requirement. Some ICDS require specific disclosures. So those disclosures have to be given in clause 13. and your accounting policies and all those disclosures have to be documented and annexed to the 3CD. So these are other clauses which we have already discussed. I'll just summarize my last area of discussion. So these are the commonly found errors as per ICAI, which a tax auditor normally does while preparing a tax audit report. One is your taxpayer's responsibility has to be specifically documented in your 3CA, 3CB. So this is something which is not done by most of the chartered accountants. This is an observation of ICAI. So that has to be done. And some require a reference. Sometimes tax audit reports, they give all things as annexures, and at that time that has to be specifically documented. Qualifications contained a reference to Form 3C. These notes did not contain any qualifications. So qualifications should always form part of 3C and 3CB, and that cannot be given as an annexure. You have to take proper care that UDIN is generated, UDIN being mandatory. So that has to be, you have to ensure that UDIN is generated. These are the general suggestions which we have already discussed, that you always, it should be based on books of accounts, and you have to take all items into consideration before proceeding for tax audit. And this is something which we have already discussed. Can a tax audit be revised? So previously there was nothing which was available for revision, but now there is specific amendment in Rule 6G which require a revision to be done only if there is a change in Section 30 and Section 43B related disallowance. This is something which we discussed, that what the CPC would do, adjustments, if there is any mismatch between your ITR and 3CD. So that is it from my side. And this is obtaining MRL and all. So these are general, this particular slide deck would be made available. So these were the key points, and there are annexures which are there to this particular. So that is it from my side, and I would be happy to take any questions.
Thank you, Rajesh. Welcome to Vice Chairman of Hyderabad Branch, Deepak Ledda. Welcome, sir.
In Q&A, we have one question.
HS, can you please take up?
Sir, Bhaskar Kumar is asking payment to related parties disclosed and added back by CPC, whether this is general disclosure or if disclosure automatically will be considered by CPC as proposed for dissolvents.
So this is something which is, it's a kind of error which is being done by CPC, sir. The adjustments cannot be made just because there is a disclosure in tax audit report. Tax audited report requires you to disclose all the related party payments, and the AO at the time of doing assessment, if he found that it is the amount which is paid to related party is unreasonable or excessive, these two words are the key points, unreasonable or excessive, only at that time adjustment can be done. Else you have to either file a grievance or file an appeal with against the CPC adjustment.
Thank you, Rajesh sir. I am requesting Deepak sir to say a few words as a closing remark.
Okay, sir, nothing much, an excellent presentation by both the young champs, Mithilesh ji and Rajesh Vaishnav ji. A super presentation, a comprehensive 360 degrees clause by clause tax audit point covered by Rajesh ji, and on the transfer pricing, sir, Mithilesh ji has covered very good important points. So congratulations and all the best for your future presentations to the Hyderabad, and we wish that you all developed as a national speakers in the coming years. That's all, sir, and we also thank all the participants who have joined us after a long gap due to the branch elections and other reasons, you know all that. So please request you to the more programs are being planned in the month of February. We will keep you posted. So please honor us and join us for a learning session, learning months in the days to come. Thank you, Shatiji. Back to you.
Yeah, thank you, Deepak sir. Rajesh sir, can you please close your this one? What do you say? Screen sharing, sir.
Sure, sir, sure.
Sir, please accept our virtual certificate of appreciation as a token of appreciation and gratitude from Hyderabad branch. We sincerely thank you for accepting our request, and we are blessed to have actually both the speakers, gem speakers today. Thank you once again on behalf of Hyderabad branch. Thanks to all the members for joining today, and requesting everyone to join for the upcoming program, which will be announced very shortly in a day or two. Mainly, first will be on the budget meeting, and thereafter one more tax side program is there. Till then,